My base case is that the president really likes tariffs. We are in for a much higher U.S. tariff regime.
There's a lot of uncertainty out there in terms of the effects of tariffs.
The only constant here is change. I don't necessarily think that August 1st is necessarily a hard and true date.
This is the end game. We'll certainly see more certainty. We've accepted the fact that tariffs are here to stay.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, the Fed under siege.
We have inflation now totally under control. We have a Fed chairman that, if he was doing his job properly, would lower interest rates. But you want to see a rocket ship? We should have the lowest interest rates, because without us, there's nothing.
President Donald Trump once again laying into Fed Chair Jay Powell. As FOMC officials remain divided on the impact of higher trade tariffs, the White House threatens to impose 50% levies on Brazilian goods, muddying the picture heading into August 1.
Perfectly framed at a time when we've been struggling to understand exactly what the objective is for the trade war. This particular levy is confusing to people who understood this within the rubric of some sort of surplus versus deficit. Last year, the United States had a trade surplus with Brazil. This has to do with politics. So all of a sudden, you have to understand the modern trade war within the rubric of potential deficit, potential income, and now a potential political preference.
And the idea now is that potentially this is going to persist based off the whim of the president for other issues, not when it comes to the trade deficit. When they invoked IEPA on April 2nd through an executive order, it was because they declared trade deficits and what you're dealing with in terms of trade partners that the United States has this deficit with as a national emergency. Well, now they're saying this has to do with political issues that the president of the United States does not like that's happening in Brazil. So who is going to be next? And do they need to issue another executive order for this? Because what's the legal authority?
We're not getting rate cuts anytime soon. We are getting higher tariffs, maybe as soon as August 1, and this market doesn't care. You've said this a few times. This market is not the economy. I'd go one step further. This market is not the goods economy. And you can see that based on some of the headlines we've had in only the last 24 hours. Nvidia, $4 trillion market cap. Overnight, revenue from Taiwan Semi. Better than anticipated 39% gain in the June quarter. And I've said this a few times in the last day as well, the last week. Meta's Mark Zuckerberg is paying people hundreds of millions of dollars. That guy does not care about trade tariffs. This market doesn't seem to either.
Ultimately, this is the new tool for discovery, for exploration and domination. And ultimately, this is not a tariff-sensitive area. And that is what we are learning with the AI trend really driving the returns. It really goes to the question, how much signal do you get from equity markets right now about the health of an economy when it is driven by the $4 trillion Nvidia that it hit briefly yesterday? It exceeds Germany's total market capitalization by almost $1 trillion. It is a nation state unto itself, and it is the driver at a time where this is the technology that a lot of people say will be more revolutionary than even electricity.
They're not worried about what's going on in the tariff situation. They're not worried about more potential export controls coming out of this administration. And then you look at the Fed minutes that say they point to, quote, considerable uncertainty about the timing, size, and duration of the tariffs' potential effects on inflation. What does the Fed do when you have things like 50% on copper, 50% on Brazil, and you're unsure what it's anchored to legally? They just have to sit and wait at minimum till August 1st. But how much do these deadlines just get pushed down the timeline?
This Fed is incredibly divided. You could see it in the minutes yesterday. We've got 10 saying 2 cuts, 7 saying none, and two pushing for something as soon as July. And I think we know who those two officials are.
Yeah, say Bowman and Waller without saying Bowman and Waller. A couple of participants noted that if the data evolve in line with their expectations, they would be open to considering a reduction in the target range for the policy rate as soon as, get this, the next meeting. And we know who these people are. There also is a growing sense that maybe we are already close to neutral. In other words, the Fed wouldn't have to cut that much to get to where it would be not restrictive nor easy for the overall economy. That's pretty profound at a time where a lot of people are wondering how much heat's left in the inflation story and in this economy.
In the meantime, equity's doing okay. We're down by about 0.1% on the S&P 500. Coming up this hour, we'll catch up with Marvin Lowe of State Street with stocks just shy of all-time highs. The EU's top foreign affairs official on the status of trade negotiations, and Meghna Maharishi of Skift reacting to earnings from Delta in about 25 minutes' time. We begin begin this hour with stocks lower as traders digest the latest trade developments. Marvin Lowe of State Street writing the following. While continued gains into the fall will need an almost perfect execution of continued disinflation, stable employment and a positive business response to the tax bill, we think there is scope for further gains through earnings season. Marvin joins us now for more. Marvin, good morning.
Good morning.
How dependent are we on rate cuts, if at all, from this Federal Reserve?
You know what? I don't think that from a risk perspective, we're reliant on it now. We have to feel that rate cuts are still the most natural way rates are going to go. We're not talking hikes. You know, that's a big difference. But the timing of it has always been fluid. At this point, the market expects exactly what the Fed is saying, 2 by the end of the year. But the Fed is also saying they don't know either. So the market is, you know, if you will, absorbing that and rolling with it.
You say the market. Let's identify which market. Torsten Slock of Apollo came out earlier this week and said, look at bonds and look at equities. And said bonds are pricing in rate cuts and a growth slowdown. Equities are pricing in better growth, particularly through 2026. Is that a difference that's straightforward to explain this morning?
Yeah, you know what? The markets are an incredible discounting mechanism, but sometimes the amount of information it can discount gets cloudy. And I think right now, equities and risk are discounting the here and now, what they know. And what we know is that the world is nowhere near as bad as we thought it was going to be 3 months ago. And there's been a bit of catch up. And we also know that information coming out of the administration is as frantic as it ever is. So we'll grab hold of what we know. When we kind of talk about equities at kind of this all-time high, you mentioned it. It's very, very narrow. It's based on things that we know. It's the companies that do have the margins, that have the revenues, and have a business model that has an appeal, if you will, in a world where you have to invest in something. Other assets, however, whether it's on the equity side of things and or the fixed income and currency side of things, are saying that it's much cloudier. So the messages are not necessarily consistent, but they're also not looking at the same things always.
The Fed members seem to be battling over this sort of tension, whether growth is slowing down or inflation could potentially be speeding up. And that's the cloudiness that you see sort of baked into the fixed income market. Which do you think is ultimately going to win out if you look at the tea leaves under the hood? Yeah, I mean, I think we've learned that they policymakers, whomever, need to have a clear message on inflation. It is once it gets into an economy, it affects everyone in a way that's very, very hard to control. The growth side of things certainly is something that you have to watch, but you know we are back to looking at inflation as the most important aspect, particularly after the jobs report, which showed that things are okay. And you think that actually you're going to see some sort of acceleration in inflation, and we're going to see that come through a little bit in the CPI report next Tuesday, and then beyond to continue to see that. I just wonder if the Fed does cut rates. How high do you see 10-year yields going at a time where a lot of people are gleaning comfort from yesterday's auction that went pretty well? Yeah, I mean, I'm still in the camp that we get a steepening curve. Not necessarily just from the discussion about the short end, but there is a lot of inflationary pressure that is coming out of this administration, whether it's from the deficit perspective aspect, whether it's from, potentially being too aggressive on rate cuts, which certainly would be reflected in that term premium. And then there's the ongoing immigration discussion, which made its way into the minutes also in terms of uncertainty in the jobs market. All of that is the parts of the crystal ball that are very, very cloudy for the Fed, as it is for the market, and they're just sitting tight for it.
We might see the administration punt when it comes to these tariff deadlines. Can the Fed cut amidst a trade war?
I don't think so. Particularly given how frantic the process has been. If in fact we get to a point where 10%, if you will, is announced, I think that's kind of what the base case in the market is, and you get comfort that that's where it ends. Yeah, then it's a clearer kind of environment. But I wouldn't expect political uncertainty to get much better.
If that is the analysis, then how can the Fed cut at all? Because the president is using Brazil yesterday based off political reasons, not even because of using it based off the trade deficit, while he used all these others on April 2nd. Yeah, that's the persistence aspect of the concerns that the FOMC started to raise. Amongst a much broader category, rather than just the few that we're talking about, July cut, if you will. And that really does keep them on the sidelines.
Lisa, you mentioned some of the bond auctions. 10-year went pretty well just yesterday. 30-year auction coming up later this afternoon.
Yeah, we got $22 billion of 30-year bonds being sold at a time where the steepening yield curve is definitely an issue. Marvin, in your notes, you said that you see 10-year yields at 5%.
Yeah,
Can you talk about what that does to the overall risk-adjusted returns across the spectrum and whether that challenges some of the rally that we've seen?
You know what? I think that to a certain degree, this narrowness in the rally that we're seeing, again, with these mega caps that have a lot of cash, that really don't need to rely on the bond market and are so, if you use the discount dividend model or any kind of discounting mechanism, all of their revenues are so, all of the, if you will, terminal value is so far out that discount rate doesn't matter as much, particularly if it's in flux. There are aspects of the of industry groups that are much more reliant on it, however, and I think that we are seeing kind of that nuanced approach in terms of, again, what we know now versus what we're uncertain about.
The good news, I guess, overnight for the Treasury came from Tokyo. 20-year bond supply out of Japan went okay. I stress okay, not tremendously well, but went okay, which is good enough.
People saw that as a potential risk asset, considering the fact that 30-year bonds over in Japan have been driving some of the volatility that we've seen. If you take a step back, how much of this is just expectations that were very, very low and crossing a very low bar? And how much is this something that really highlights how much treasuries across the world are adjusting to this by not issuing as much of the debt and actually helping really ease some of the tensions of these auctions?
Bond yields this morning just a little bit higher by 2 basis points on a 10-year, 435. Additional supply coming later. The 30-year, about 490. Marvin, good to see you, as always. Marvin Lowe there of State Street on an equity market that's very close to all-time highs and a bond market where he's still looking for 5% along the yield curve. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Lizzie Burden. Hey, Lizzie.
Hey, John. President Trump says the US will begin levying a 50% tariff on copper imports on August 1st. After the announcement, Trump took to Truth Social, posting this 50% tariff will reverse the Biden administration's thoughtless behavior and stupidity. Trump said America will once again build a dominant copper industry. And Meta poached the head of Apple's AI models team. Sources telling us here at Bloomberg that he was lured over with a pay package worth over $200 million that will be stretched over several years. The compensation is in line with other major hires for Meta's new superintelligence team, which is focused on building AI systems that can complete tasks as well as or better than humans. And Kellogg shares rallying after the Wall Street Journal reported that the Italian candy maker Ferrero is nearing a $3 billion deal to buy the breakfast cereal conglomerate. The Fruit Loop maker has a market value of about $1.5 billion and more than $500 million in debt. The deal could be finalised as early as this week. And that should be my brief, John.
Hey, Lizzie, thank you. More from Lizzie in about 30 minutes' time. Up next on the programme, President Trump setting higher levies.
Sir, can you explain how you calculated your latest round of tariffs? Was there a formula that was used?
The formula was a formula based on common sense, based on deficits, based on how we've been treated over the years, and based on raw numbers.
Up next on the programme, we'll catch up with the EU's top foreign affairs official in just a moment, plus the latest from the Capitol with Tyler Kendall. Live from New York City this morning. Good morning. Here's your day ahead, your morning so far, 15 minutes away. We kick off earnings season with Delta Airlines, 6:30 Eastern Time, so look out for that. Later on this morning, 8:30, 2 hours after that, we'll get jobless claims. And then this afternoon, 30-year bonds coming to market, $22 billion worth. As Lisa pointed out, the 10-year auction yesterday, pretty decent. That snapped a run of higher yields for 5 consecutive days. Yields this morning back higher again, though, up 2 basis points at the long end of the curve on a 10-year, about 435 on 30s. Let's call it 490. Under surveillance this morning, President Trump setting higher levies.
Sir, can you explain how you calculated your latest round of tariffs? Was there a formula that was used?
The formula was a formula based on common sense, based on deficits, based on how we've been treated over the years, and based on raw numbers. Brazil, as an example, has been not good to us, not good at all. But they're based on very substantial facts and also past history.
It's the latest this morning. President Donald Trump confirming an August 1st start date for tariffs on copper. Trump also taking aim at Brazil with a potential levy of 50%. Joining us now from the nation's capital in Washington is Bloomberg's Tyler Kendall. Tyler, Brazil, this is the question a lot of people are asking. How are they justifying that 50% levy?
Yeah, hey, John, good morning. Well, it is worth pointing out that the U.S. actually ran a $5.5 billion trade surplus with Brazil last year, which means that this doesn't fall into that category or that legal basis that the administration has been arguing, that they are enacting these tariffs on the idea that there has been persistent trade imbalances and deficits that have hurt U.S. interests. Instead, President Trump has linked this to political concerns and an ongoing trial of the former Brazilian President Bolsonaro, as well as allegations by President Trump that the Brazilian government is censoring U.S. social media platforms. Now, in a post last night, we heard from Brazil's current President Lula, who defended his government's actions when it does come to U.S. digital platforms operating in the country, as well as said that any unilateral tariff rate imposed by the United States would be met by their own country's reciprocity law. We have to give the context here that the U.S. is the second largest trading partner for Brazil, only behind China, and analysts tell us that a 50% tariff would essentially make trade unfeasible between the two countries. So there are really big impacts here on the line. But at the moment, it's unclear how the administration would justify this on a legal basis, since we've seen IEEPA imposed, for example, based off this idea that there have been these persistent trade imbalances.
Tyler, with the latest down in Washington, Tyler Kendall, thank you. Lisa, I think you asked about 15 minutes ago. Politics or economics? How do you justify it?
And this is going to ultimately come down to how much is trade being used as a tool to negotiate certain political outcomes. This has to do with Bolsonaro, Jair Bolsonaro, who did officially lose in the last election. And President Trump has drawn parallels between his plight and some of Bolsonaro's and has talked about the discussion around criminal investigation and trying to withdraw that.
The lines are being blurred to try to understand why they continuously use tariffs and trade as the first tool in the toolbox when they have a grievance with a country. When you look at copper, the president is talking about national security concerns, and I think a lot of people can get on board with that. In the same day, he's going after Brazil, which goes against the executive order about why they were going after countries when it comes to trade deficits, and that using IEEPA, that was their stance legally. Now they're just doing it for domestic politics in another country. And this is where I think it's going to be very concerning for a lot of Republicans in Congress.
That August 1 deadline, only a few weeks away, and countries are racing to try and strike deals. Joining us now, I'm pleased to say, is Bloomberg's Min Min Lo from Kuala Lumpur. Min Min, good morning.
Good morning. Yes, I'm here at the ASEAN Summit, and it's a big day because the ASEAN foreign ministers are meeting with many key dialogue partners, including the envoys from Korea, Japan, China, the US, and of course the EU as well. And joining me here is the EU's top diplomat, Kaja, Kallas. Thank you so much for making time. So tariffs have been looming very large over this entire summit. The EU hasn't yet received that letter from Trump. What is your team expecting to see when that letter comes? Any specific carve-outs in particular that you're expecting to have achieved?
Well, of course, our trade team is working very hard to get good agreement. But at the same time, we are also working with other countries like here in Southeast Asia or in the world to have trade deals and trade agreements to diversify our trade portfolios.
Okay, so the Chinese Foreign Minister Wang Yi is here as well. Are you going to meet him to maybe stabilize relations a little bit? Because it seems like the EU-China summit might be partially derailed from what we have reported before.
We had a good meeting in Brussels with my counterpart, and we are discussing. It's the same format that we had in 2023, the summit then, and it's important the substance. What are we discussing?
But you're cutting it short, and you're not bringing any additional business delegation.
No, there was no plan. That was the question that actually wasn't clear how China wants to hold this summit. And now we know that it's one day, and what kind of meetings we have and what discussions we have.
What is your response to China's assertion that the EU's public procurement has been unfair, that the EU does have its own immense subsidies for its manufacturers and producers as well? Is there a double standard being applied?
No, well, our subsidies are in accordance with the WTO rules. So this is very, very clear. We want a level playing field. We are very worried about the economic coercion of China, and we are also worried about their enabling Russia's war in Ukraine. So these are the two big issues we have.
Let's talk about Gaza, because President Trump said that a ceasefire could be in sight this week or next week. What do you envision as the EU's role in supporting that ceasefire?
Well, we have been working very hard since the last Foreign Affairs Council that we had in Brussels with the Israelis to really improve the situation on the ground with the humanitarian aid for the people so that the situation would be better. We achieved an agreement on very concrete terms, how many trucks will get in, how many crossings will be opened, distribution points so that people would receive help, water distribution for the Gazan people, also waste management, a lot of issues. We reached an agreement, and we really need to see also this agreement put in practice, the implementation. And I'm glad to hear that already today there were improvements like fuel getting to the hospitals and the situation being a bit improved.
Right. Ukraine's intelligence says that Laos is prepared to send up to 50 troops to a place in Russia for mining operations. Given that Sergei Lavrov is here in ASEAN, to what extent are you worried that he is here to beef up recruitment for the war in Russia, in Ukraine?
Well, of course, Laos has denied this, and we will have a meeting also with representatives from Laos to ask, because we also give a lot of development aid to Laos, and if they are supporting Russia's war, which is an existential threat to Europe, then we have to look into our arrangements. It just can't be that you're getting support from us and at the same time undermining us.
Okay, just very quickly, we know that Myanmar's junta has been squarely under Moscow's orbit as well. The coup's chief traveled to Russia and Belarus as well. Any insight as to what sort of cooperation is underway that could support Russia's war machine?
Well, of course, we are worried about all these steps, and it's clear if we look at the bigger picture that these autocratic rulers are really teaming up, which is dangerous for everybody. And that's why we really need to stand up for the international law, international rules-based order, and defend it with the countries that share these same values.
All right, thank you so much. That was Kaja Kallas, the EU's top diplomat, speaking to me here at the Kuala Lumpur Convention Center at the ASEAN Foreign Ministers meeting.
Hey, Minmin, thank you. Nice work, as always. Appreciate catching up. If you go back, let's say, to April 9th, President comes out, 90-day pause. And by July 9th, we're going to renegotiate things. I think we'd all sit around this table. In fact, we did. And we said by the time you get to the morning of July 10th, the EU won't be in a good place based on what we'd heard from the President at that time. The EU's in a very different place compared to where they were 3 months ago.
They're in a better place in some ways. They've been really working with this administration, and the mood music around that has been a lot better than, say, places like even Brazil or even Canada. A real question here is, what are the details going to look like, and do they get a letter anyway, just because a lot of people are going to be getting letters in the next couple of days?
When it comes to the European Union, they decided to do damage control, and it wasn't just Ursula von der Leyen. Leading up to this relationship being stronger between Washington and Brussels, you had the German Chancellor calling the president. You had Giorgia Meloni, the Italian Prime Minister, an individual who, ahead of the inauguration, was making this trip to Mar-a-Lago, was an individual who had an outreach, an olive branch that was going to try to help Europe along. So you've seen them capitulate on a number of issues. What Europe is trying to do, though, is protect certain industries, like Airbus, certain autos. Bernard Arnault, LVMH, putting some pressure on Brussels to make sure they could protect some of the luxury goods, alcohol, etc. But where it ends up, we still don't know.
You want some good news? We can move on from the trade story to earnings season. Up next on the programme, Meghna Maharishi of Skift with Delta earnings just around the corner. Plus, Yahara Anna with your morning movers as Nvidia looks to start a $4 trillion club. From New York City, you're watching Bloomberg TV. Earnings season is about to begin. Numbers from Delta Airlines just around the corner. We'll get to them in a moment. In the equity market, following 2 days of losses on the S&P, we broke that yesterday, supported by some big gains in big tech, a major rally off the April low on the Nasdaq 100, and for Nvidia as well. $4 trillion market cap briefly. Equity futures this morning down by 1/10% on the S&P, on the Nasdaq 100 down by 1/10% also. With 3 hours until the cash open, let's get you some morning movers. We can do that with Yahara Arnold. Hey, Yahara.
Hi, John. We start with the American mining giant Freeport-McMoRan up again today, up 2.5% after Trump made it official, saying that a 50% tariff on copper imports will take effect on August 1st. And because of that, it's also getting an upgrade from JPMorgan. They're calling it their top pick, and they're setting a new price target of $56. That implies an upside that would mark the stock's highest close in over a decade. Next up, we have shares of WK Kellogg absolutely soaring here, more than 50% on reports that Ferro, the Italian maker of Nutella, is closing in on a $3 billion deal to buy the cereal maker. We're reporting a deal could be finalized as soon as this week. So why would Ferro want the American cereal giant? Well, it's a chance for it to break deeper into the U.S. breakfast market and also diversify beyond sweets and chocolate. And I want to end with a check on Nvidia. As you were mentioning, shares are up just slightly, about 0.6%. But of course, it became the first company ever to hit a $4 trillion market cap yesterday. Just briefly, we are off those levels now, but still worth noting given the huge milestone, John.
Yahara, thank you. Thank you very much. More from Yahara in the next hour. Let's get to that headline. The news this morning from Delta Airlines. Does this set the tone for this quarter? Restoring full-year guidance.
And what you're seeing is the shares popping some 7.5% ahead of the market open and pre-market trading. They're saying that, again, to your point, they had withdrawn these earnings forecasts back in April on the heels of some of the tariff announcements from President Trump. They're reinstating them, saying that you're seeing a firming up of consumer demand for domestic travel. And you could see the response very much coming from markets saying, hallelujah, is this really what we're going to hear from the rest of them?
Let's go back to mid-February and think about why they warned to begin with. It wasn't just about what might happen, what might not happen with tariffs. It was also about safety issues for aviation. It was also about DOGE cuts hitting business spending, and a lot of the airlines followed after that. And I wonder what is behind the consumer rebound that they're speaking to.
Yeah, this is something that we've talked about. How much is Delta benefiting at the behest of, say, JetBlue or some of the other more discount-oriented, vacation-oriented airlines? Is this coming from business demand? Is this coming from leisure, the business-leisure blend-up? Is this coming from higher-income travelers that tend to also have the premium offerings? We're going to have to really dig through this to understand exactly how much we could extrapolate out to the other airlines and to the other industries.
It feels like it is, because Delta is saying premium revenue continue to outpace the main cabin, and corporate demand environment remains steady. So if you're in corporate America and you're concerned about all these tariffs, well, guess what? You're still spending, and you're still spending on sending your employees out and flying business class.
The latest from Delta Airlines this morning in the pre-market up by 7%, restoring full-year guidance, a range for EPS of 5.25 to 6.25. The estimate was 5.35. Joining us now is Bloomberg's George Ferguson. George, good morning, sir. Thanks for joining us as we kick off earnings season with the airlines. The news from Delta Airlines. Your reaction, please.
Yeah, so, I mean, a slight beat on the numbers. My sense was when Delta withdrew guidance was more that they were concerned. They didn't understand what was going to happen to the economy. And it seems like it's held in there better, right? So with a slight beat, seems like revenue is hanging in there, like you read through some of the report. So I would think, first of all, to be a positive for all the airlines, but mostly it's going to be a positive for the big full-service carriers into this earnings season.
George, Annmarie really nailed it when she was talking about how a lot of this was driven by the premium offerings. How much are you going to see the ongoing divergence between the airlines that can cater to the higher income individuals versus those that have a more kind of budget-friendly approach to their marketing?
Yeah, I think you're going to continue to see that divergence. Again, though, I think if demand is holding in there, it's a positive for all of them. But we've seen premium outperforming. I think at the bottom end of the scale, the budget and the ultra low cost carriers, they are starting to put some of that capacity behind them. They're starting to get rid of some capacity in the marketplace, which should help them improve profitability. But I still think it's a little bit early in that. And so I would, again, expect that the big full-service carriers, Delta, American, United, are going to see better results because of that premium passenger and business.
We're seeing the trading action, people really cheering in pre-market activity, this reinstatement of the guidance for the full year. I'm just wondering how low the bar was, how much pessimism has gotten baked in, not just to Delta, but more broadly to the entire airline sector.
I think there's a lot of concern in the airline sector. We'll have to, again, parse through the earnings they've just come across. But the big full-service carriers really benefiting from foreign travel into Europe. That seems like it's been holding up. And so, again, I think that's another tailwind for the big three here in the U.S. But I think the pessimism in the marketplace had been, pretty widespread recently.
The move this morning speaks to that. George, thank you, sir. George Ferguson there of Bloomberg, the latest on Delta moments ago. Decent numbers, reinstating the outlook, speaking to a consumer rebound. Ed Bastian, though, listen to this quote. I think going one step further, saying this: people are starting to understand with clarity where things are headed, and that allows them to start making plans, whether to travel or invest in a business. That's not just a comment on airlines. That's a comment on the broader economy.
And this goes to the certainty that we have gotten, which is you can say a lot about the trade negotiations and where we are. We know that tariffs are going higher. We know that companies are adapting and adjusting to some degree. The one big beautiful bill arguably is a greater certainty that people have behind them that has been passed. So that has allowed certain companies to make investments, and maybe that's part of what he's speaking to.
Is this a statement on the economy, the industry, or is it just Delta Airlines? Here's a quote on Delta Airlines. Meghna Maharishi of Skift, a travel industry news and research firm, writing the following: Delta is probably one of the most strongly suited airlines to weather the uncertainty. Meghna joins us now for more. Meghna, good morning. It's good to see you.
It's good to see you.
Is this Delta? Is it just unique to Delta Airlines, or do you think this is someone saying, you know what, the economy is a whole lot better?
I think it's a lot more unique to the legacy carriers generally. Since the pandemic, we've seen this dynamic where the legacy carriers have been booming, and that's been primarily fueled by international and premium travel, a lot of wealthier travelers wanting to travel in those segments, and that is something that those airlines have invested heavily in. On the other hand, there is still some economic uncertainty for consumers when it comes to these tariffs because it's been an on and off again threat, and the deadline has been extended so many times. And I think that is still weighing down on more cost-conscious consumers, which may become a longer-term concern for airlines, but at least right now, it seems as if international and premium is really offsetting whatever weakness is there among that cohort of travelers.
Which really raises the question about whether airlines are kind of a microcosm of the broader trend, which is that wealthier individuals are continuing to spend, are continuing to travel, are continuing to live their lives, and lower-income consumers are really pulling back and retrenching. Do you expect the results to actually be increasingly negative, at least with respect to the major airline carriers, from the likes of JetBlue, Frontier, the other types of budget-conscious airlines?
Yes, I think budget-conscious airlines, as budget airlines are in a far worse position than maybe they have been a year ago. Right now, what we've been seeing is, at least with domestic airfares, demand in domestic travel has been pretty weak since the first quarter. So airlines have been aggressively discounting those fares. They've been cutting capacity. And now with these budget-conscious carriers, they're now going to be actively competing with these legacy carriers on those airfares. Everybody's discounting them, and it puts them in a position where they need to be selling the lowest possible price, and that's already been very difficult for them.
How much of a tailwind are gasoline prices for all the airlines, considering that most of them are unhedged when it comes to the price of crude?
I would say right now fuel has been a bright spot this past year for airlines, at least in the first quarter. With fuel prices, they were down. I think that gave airlines a boost amidst a lot of that economic uncertainty that they were feeling when we saw all these airlines pulling their outlooks. But obviously it changes pretty frequently. But it seems right now that is a pretty bright spot for them.
Given that it feels like Delta, at least, is saying we're over the uncertainty hump, do you think 2025 will see more demand and better growth for airlines than 2024, or is it a wash still?
I think it's probably still a wash. Obviously, I think for carriers like Delta, United, and American, that demand will stabilize, and they will still have probably very strong demand for international and premium travel, which will offset a lot of other weaknesses. But I think for the other airlines, it will very much feel like a recessionary environment because they are mostly domestic airlines, and those travelers are pulling back their spending for the most part.
Can we make the argument it puts some pressure on the rest of corporate America this morning? Going through earnings season, you're not going to get a pass. If Delta can do it, why can't you?
If you are seeing a firming up in certainty, then reinstate your guidance. It's not good enough to just say, I don't know. And that, I think, is a really important point. Remember, they got a pass when they reported earnings back in April, right after the tariffs were announced. That ship has sailed.
If you're another airline and you were thinking about not offering guidance this quarter, this puts some pressure on you big time.
And it also points to the fact that you could be punished severely if you continue with the ambiguity, because what are you seeing that the rest of the world is not?
And rewarded for saying things are OK. The stock is higher by 9% in the pre-market. Meghna, thank you for dropping by. Appreciate it. Meghna Maharishi there of Skift. Let's get you an update on stories worldwide, including the latest on Delta Airlines. Back with us with our Bloomberg brief is Lizzie Burden. Hey, Lizzie.
Hey, John. Delta Airlines surging in the pre-market. The company reporting better than expected second quarter earnings and reinstating its full-year guidance after pulling it last quarter. Delta's results were driven by international premium demand and loyalty travel. Demand for economy class trips in the US and abroad stalled. Elsewhere, the AI spending boom continues. Taiwan semiconductor revenue rose 39% in the June quarter, beating expectations as AI application interest drove demand for its products. The CEO said AI chip demand still outstrips supply and has pledged to spend $100 billion on ramping up manufacturing. And Amazon's annual Prime Day sale is underway, and initial numbers from the 4-day shopping event are indicating weak sales. Brand advisor Momentum Commerce reported a 41% drop in first-day sales compared to a year ago. Amazon is betting on the extended sale period to give shoppers more time to navigate the millions of deals on its site. And that's Bloomberg Brief. John.
Lizzie, thank you. More from Lizzie in about 30 minutes' time. Up next on the programme, US Treasuries catching a bid.
There still is a tremendous amount of demand for bonds. There's a tremendous amount of demand for treasuries. Everyone is asking me, where do we get in? How do we get in? What do we buy?
Things are just stabilising in the bond market, starting to settle down. We'll get the latest from Lotfi, Karoui of Goldman Sachs in just a moment, plus a recap of earnings season so far. One name, starting off with the right tone. Delta Airlines at a pre-market higher by 8.5%. This is a solid start to earnings season. In the pre-market right now, Delta Airlines higher by 10.5%. Delta catching a bid this morning off the back of better than expected earnings, reinstating the outlook. And I think this is a really big sign of confidence coming from Ed Bastian, the CEO, Bramo. People are starting to understand with clarity where things are headed.
Yeah, and meanwhile, the president went on to say that demand trends are stabilizing and we continue to see resilience in our diverse, high-margin revenue streams. Guess what? People are still going to Puglia. People are still going to the south of France. People are still going all across Europe. And you actually see that transatlantic travel increasing another 2% on top of the insanity last year, which is crowding out a lot of tourists.
I'm just going to run with that. They don't fly direct yet to Puglia, but I wish they did. Are they going to fix that?
I literally was just going to say, but Delta doesn't do direct to Bari.
JFK direct to Bari.
Okay.
Bastian, if you're watching, great results. Congratulations.
But
fix it. Stock is up in the pre-market by 10.5%. That's the stock story. Under surveillance this morning, US Treasuries catching a bid.
There still is a tremendous amount of demand for bonds. There's a tremendous amount of demand for treasuries. I think the treasury market's in a really good place right now. Everyone is asking me, where do we get in? How do we get in? What do we buy? Nobody's asking me, how do I get out of the bond market?
Here's the latest this morning. Investors looking ahead to a $22 billion sale of 30-year bonds after some strong demand for the 10-year note triggered a rally. Joining us now to discuss is Lotfi Karoui of Goldman Sachs. Lotfi, it's good to see you.
Great to see you. Good morning.
Things feel like they've stabilised. What's behind this return of confidence in the bond market?
I think you said it, which is there's been steady de-escalation in terms of trade uncertainty. We do have more clarity. We don't have full clarity, but we definitely have more clarity. And there's a sense that we sort of passed peak uncertainty after Liberation Day. Data has been okay without being spectacular, the signs of weakness here and there. And then I think what we're realizing is that there has been enough disinflationary forces in the work already that are sort of providing a little bit of an offset to, to tariffs. And so all in all, the combo is not that bad.
We've got the Treasury market one. Within fixed income, you've also got corporate credit. Let's just talk about the latter briefly. I remember your outlook for 2025 coming into this year, and I think you referred to it as the least compelling valuations for a long, long time.
Yeah.
Fair? You also said that you could be pretty constructive on the asset class because all-in yields are still pretty attractive. Is that still supporting credit in America?
We're exactly back to that conundrum. If you look at investment-grade spreads, we're below 80 basis points. Those are historically tight levels. We're below 300 basis points in high yield. If you look at yields, it isn't that bad. It's obviously not as good as it was back in April, but you still get paid 5.25%, 5.5% in IG. You still get paid 7.25% in high yield. So the value proposition from a total return or an all-yield standpoint is actually still pretty good in my view.
At the same time, there is this fear that you have two risks. You have on one side inflation, which could potentially really pressure the prices, send them a lot lower, yields higher in response, or you have a potential weakening in growth, which could potentially force that premium to go much higher on top of some sort of benchmark rate. Which do you view as the greater concern?
You have a third force, which is the direction of monetary policy, right? Because I think what we've seen so far is evidence that the news flow on the inflation front is okay. There's enough disinflationary forces, but we're heading in the right direction. Growth has been mixed. You've seen signs of weakness in the labor market. You've seen signs of weakness in the housing market. And I have to confess that came a little bit as a surprise. But, prices are down, volumes are down, sentiment has deteriorated. So the question is, what does that mean for the Fed outlook? I think what you need to see for the Fed to move is essentially a stronger embrace of this idea that tariffs will eventually be a price level effect that won't sort of de-anchor inflation expectations. And once they embrace that view, your three forces there will line up a little bit and will go in the right direction.
Given the political theater around rate cuts, what is the risk that a rate cut would have the opposite effect, would cause actually a less favorable outlook for particularly long-term bonds at a time where people are worried that maybe it's being influenced by something other than just pure economics?
I really don't think that's a 2025 story, to be honest with you. Now, look, of course, if the data deteriorates very quickly and the Fed has to respond in an emergency mode, that's a different conversation. If for whatever reason we see some, bad re-steepening of the curve driven by the 30-year, point, that would be bad too. But I think the 2025 playbook is most likely normalization cuts that bring you back a little closer to neutral.
How does the Fed embrace this idea that it's only going to be a one-time price adjustment when you have overnight the president going after Brazil, which runs counter to why he even used IEPA in the first place because of trade deficits for certain countries? How do you actually map that out if you're sitting at the Fed? Yeah,
the answer is time. You basically need time. You're in wait-and-see mode. You need time to provide you enough evidence that, things are not spilling over into the real economy in a bad way. And more importantly, that these headlines are not de-anchoring inflation expectations. So far, we haven't seen any evidence of that, actually.
So when you say time, is September early enough?
I think September, the odds are probably higher than 50%, yes.
How dependent do you think this rally is on those Fed cuts? Because what we've heard from equity investors is not very. What's the view from credit?
There is some dependency. I wouldn't say not very. I think the market is pricing in a friendly sort of mix of growth, inflation, and policy. Now, we've been sort of stuck into that range, 2 to 3 cuts a little bit. So I think the Fed will have to deliver some of that.
We were speaking with Jean Beauvais yesterday, and given all of these concerns around the United States, given the fear of some sort of backdoor monetization of the U.S. debt picture, they like European debt more than the U.S. You take the opposite approach. Why?
I think you have a better yield support in the dollar market. That's really the story in my view. I mean, look at investment-grade dollar versus investment-grade euro. There's a carry differential of over 2 points. It's hard for me to see Europe sort of outperforming the U.S. in that world. Now, there is one nuance. It all depends how you frame it, currency adjusted or currency unadjusted. I am talking about currency unadjusted returns. I would say second quarter was really interesting in my view because you had U.S. outperformance in equities and in credit alongside dollar weakness. So that tells global investors, don't shy away from the U.S., own UN assets, but own them in an FX hedge way, which is a little bit of a paradigm shift relative to that first quarter, where you had a double whammy of lower dollar and U.S. asset underperformance.
I guess then how would you recommend it to European investors, given that these hedges are getting more expensive, right? This is getting to be a very crowded trade. At a certain point, what is the point at which you start to prefer European assets over U.S. ones, given the fact that the ECB is likely to cut rates and there are disinflationary forces coming from the likes of China?
On the fixed income side, I would say reset in valuation. Quite frankly, that is unlikely given all the reasons that you just described. You had big fiscal stimulus coming out of Germany. You had ECB that is still in a more comfortable position to act actually faster than the U.S. So I struggle to see that happening. But if for whatever reason you see a reset of valuation in Europe, that would certainly change my view.
You talked about the disinflation being fed to the Europeans. I think we've got to be so open-minded about what happens with inflation going forward. The news from Japan overnight, do you see that?
Yes.
From the automakers, these numbers are amazing. Last month, the export price index for vehicles shipped to North America plunged by 19.4% from a year earlier. So that conversation about all of this will be taken on by the US consumer, that's not the case. You're seeing some evidence elsewhere that maybe they'll have to take it on the exporters side of things.
This is the most direct way of really displaying how much different companies are going to absorb it in their profit margins, and I'm talking about foreign companies. So it's not necessarily going to trickle into the US inflation picture, and we've seen that already with a number of other companies. We saw Walmart, for example, jawboning their Chinese suppliers to accept a lot more of it. So this is a complicated picture, and one of the reasons why a lot of debate is going on about the inflation picture.
And this kind of chart where you see it go off a cliff in terms of export prices, something that will actually help the administration, because they're saying, look, what you're seeing in Japan is they are lowering prices because they want access to the United States market and they want access to the U.S. consumer, even if it means it's going to hurt them in profit margins.
Lotfi, just to finish on sectors, when you look across various sectors right now, are you more constructive on some versus others?
You know, I think the big debate is really cyclicals versus defensives. We've been sort of defensively positioned into credit markets. And I would say when you look at the equity, things are a little bit distorted because of tech, because of deregulation, and because of policy shifts in sectors like healthcare. But on the credit side, the rally so far has been surprisingly defensive, meaning the leadership has been sort of tilted towards defensive sectors. Would be neutral at this point. I would wait for evidence that that second derivative is sort of stabilizing a little bit. We're seeing a couple of data points on the earnings side that suggest we might be heading in that direction, and so we'll see. But at this point, I'd be neutral.
We've all got to wait and see. Lotfi, appreciate your time. As always, thank you, sir. Lotfi Karoui there of Goldman Sachs on the latest with tariffs and what it means for this market. A much more constructive tone on US credit there.
Yeah, talking about how the all-in yield, and we've heard this a number of times, the all-in yield becomes pretty attractive. If you're talking about all of the uncertainties with policy headlines, then you're talking about clipping a 7 or 8% coupon. It looks pretty good. If, yes, valuations are tight, but it doesn't look like this corporate credit market's going to fall off a cliff in the same kind of way that it has, say, in 2008.
Earnings season so far not falling off a cliff either. One company down. One company, but it's a good company. It's Delta Airlines, and they're doing better in the pre-market, higher by 10.5%, a better outlook, better numbers, and strong guidance coming from this CEO, Ed Bastian.
You know, you nailed it. This really sets the bar pretty high for a lot of companies. If they don't put guidance out or if they don't give a sense that they have more clarity, people are going to say, is this a broader macro picture or is this a you problem?
And also, what does it mean for companies that were hoping to once again use the tariff excuse as a reason for we don't have guidance, we don't have a ton of demand because of the uncertainty? You hear it right now from the CEO, quote, it is incredibly stable when it comes to the environment.
That stock is better than stable. It's higher by almost 11%. Up next on the programme, we'll catch up with Sonders at Charles Schwab, Bloomberg's Tyler Kendall, Michael Zezas of Morgan Stanley, and, stay tuned for this one, the former US Vice President Mike Pence here in New York City. Live from New York, the second hour of Bloomberg Surveillance. Up next.
Long-term macro anchors have been lost.
The market is already injecting more risk premium into certain U.S. assets.
In the end, it comes down to risk appetite, right? Markets are behavioral.
The biggest driver of equities this quarter has actually been the AI theme. That's why I think we're making all-time highs.
The market has earned the benefit of the doubt. This kind of uptrend deserves that benefit of the doubt.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures recovering, lower by only 0.1% on the S&P 500. Similar move on the Nasdaq 100, very close to all-time highs. Later on this morning, 90 minutes away, jobless claims in America, 8:30 Eastern Time. Later on this afternoon, $22 billion of 30-year bonds coming to market at 1 p.m. Eastern Time. Already this morning, your headline, it comes from Delta Airlines, kicking off earnings season with a bang. Their stock is higher by 8.5%.
Resilience really is the theme here. They beat by just a bit, but they reinstated their forecast after withdrawing it right after the April Independence Day, Liberation Day announcement, saying that they have more clarity and that things do seem to be firming up. A real question here, is this just an ongoing aspect of the haves versus the have-nots? The wealthier individuals, the businesses that are able to travel versus the lower income consumers that are pulling back? Or does this speak to a resilience in the broader economy?
And is it those individuals flying in premium that can withstand the uncertainty and deal with it? Because at the same time, you have the Delta CEO saying it's incredibly stable environment. People are starting to understand with clarity where things are headed. Are they really understanding with clarity? We are getting trade headlines once again every single day, and even questioning the authority the president is using these trade headlines, but they're saying things are stable. The direction of travel, I think, for corporate America is clear, so they're no longer going to be using, potentially, at least in Delta's case, trade as this excuse.
This market's rewarding confidence. Their stock is higher by 9%. If you don't have clarity, what's your excuse? That's the question we'll be asking through earnings season now. Off the back of this.
And it's going to be harder to parse what's a specific company story versus what's a macro story. And we've been talking about this. Remember, whenever there's a strong dollar or a weak dollar, people say, well, it's this expense from FX valuation. So is this going to become the new sort of boogeyman that another number of companies that already are struggling will be pointing to? We're going to see an ongoing diversification between the haves and the have-nots within corporate America, the ones that are biggest and boldest enough to withstand some of the tariff pressure and those that are having a harder time. And I think this earnings season is going to be interesting that way.
The big keep getting bigger. Nvidia's a fantastic example of that in the last 24 hours, briefly a $4 trillion market cap. And there are certain sectors which just do not care about the conversations we're having every single day. The demand for AI themes at the moment, not just through Nvidia, but the numbers from Taiwan Semi, I said it earlier on this morning, phenomenal revenue numbers from that company.
And the offers from Meta highlight how price insensitive some of these hyperscalers and investors in the AI theme really have become. This isn't a tariff-sensitive area. This isn't a cyclical area. This is a secular structural change in the economy and in technology. And it's one of the reasons why it's hard to get a signal from a stock market that's continuing to gain on the backs of those behemoths, not necessarily some sort of broader strength that can be applicable to the broader economy.
Well, this is a perfect point Torsten Slok is making this morning. Is the stock market actually representative of corporate America or just the Mag 7? He says anyone investing in the S&P 500 today is basically making a bet on the Mag 7 propelling even higher because the concentration right now is at extreme levels. The top 10 companies accounting for 40% of the index.
I keep going back to this quote from Ed Bastian. I think we all have to keep going over it. People are starting to understand with clarity where things are headed, and that allows them to start making plans whether to travel or invest in a business. The current environment he called incredibly stable. That is something, language we've not heard from any Fed official at all, whatsoever, in the last 2 months. Why?
Partly because they don't understand if the stability is fleeting or if it's longer lasting. When I've spoken with Fed officials off the record, and I'll just be really honest without mentioning anybody.
It's no longer off the record now, is it?
It's on background, whatever you want to call it. Never mind. I will just say my observation, if I were channeling a Fed official and speaking to myself, would be that, it seems like corporate executives have a good degree of confidence because ultimately people keep spending. I was looking yesterday at the Atlanta Fed wage data, and it's actually increasing at about 4.2% year over year. This is still decent. It's not necessarily runaway and inflationary, but it's solid. And that is the reason why people are looking at the steadiness and saying that can propel this economy even in the midst of an incredible amount of uncertainty.
Good save, Bramo. Nice save. Equity futures right now in the S&P negative by close to 0.1%. Coming up this hour, we'll catch up with Sonders of Charles Schwab. Looking ahead to second quarter earnings, Michael Zezas of Morgan Stanley with stocks falling on renewed trade concerns, and the former US Vice President Mike Pence joins us for the back half of the hour. We begin this hour with stocks fairly stable so far this morning in the face of renewed trade concerns. Sonders of Charles Schwab writing second quarter earnings calls are critical to assess how companies are handling tariffs in terms of pass-through and/or profit margin compression. I'm pleased to say that Lizanne is back with us for more. Lizanne, welcome back to the programme. We've got to pick up on Delta Airlines. They seem to have some clarity and some confidence for the future. Do you think we'll see a repeat of that through this earnings season?
Well, John, I heard you earlier. I think you're absolutely right that certainly within the airline space, it's going to be difficult for any other airlines that might have withdrawn guidance or provided a really wide range or scenario analysis to not narrow that in a little bit. But I found the use of the word stable a little bit odd, or at odds with what has been a pretty unstable backdrop, particularly from a tariffs perspective. So I think I also heard you earlier. I think the passage of the budget bill is good in the sense that you've got that surety from a corporate tax extension standpoint, from an expensing and depreciation standpoint, but it is still a kind of whack-a-mole environment from a tariff perspective. So I wouldn't describe the backdrop as stable broadly.
Lizanne, maybe not in the headline stance, but from an economic stance, are consumers getting as tired from all of the headlines and the headline roulette as some of the trading partners seem to be getting? This idea that people are getting used to this environment of uncertainty, looking at their paychecks, looking at the fact that the economy keeps grinding along, and developing a level of certainty in that.
Well, except that I think, Lisa, you pointed out earlier, we have a bifurcation. I think we may be using the K letter again to describe the backdrop, particularly as it relates to the consumer, because you are seeing pressure on some of the lower end consumers, inclusive of, now that there's no more moratorium on the reporting of student loan delinquencies, they've shot through the roof. That feeds into credit scores, credit availability, access to other forms of loans. You see it in the retail sales data that have been generally weaker. The next report coming up in the next week is important. You also saw the downward revision to Q1 GDP, a pretty hefty chunk of that was a consumption revision lower. So I think there is still some resilience, but it's more up the income spectrum. I think where you're seeing the pressure most acutely is down the income spectrum, not to mention the fact that within inflation data, the non-discretionary components, the needs components, that's where inflation has been stickiest on the high side, and added pressure for lower end consumers because more of their spending goes into those needs buckets.
This really raises a sort of a deep question about the stock market and the sort of cyclicals versus defensives that we've been talking about, and what is defensive at a time where the big tech names just seem to be invulnerable to any potential changes in the broader economy. I just wonder, can cyclicals rally on the heels of just the high-income consumer again and again? Or are you going to start to see what you're talking about, that K-shaped economy, play out in a much more significant way in the upcoming earnings quarters?
Well, I think what I would guess would happen throughout second quarter earnings season is a bit of a continuation of what we have seen in recent quarters, where the beats don't get rewarded anywhere near to the same degree that the misses get hit. So I think there is still that sensitivity, but I do think we are going to get more meat put on the bones in terms of what the strategy is, what the pricing strategy. We know that a lot of companies built up a massive amount of inventories at a low cost basis, ostensibly giving them an opportunity to kind of experiment with price increases. So I think we're going to, or analysts are going to be asking pretty pointed questions about pricing strategy, about profit margins. In terms of the cyclical outperformance, I mean, industrials is by far the best performing sector this year, up 13 or 14%, besting even technology and communication services. Also at play here and what's doing well are sectors and industries that have a high portion of their revenue growth coming from overseas sources. And that's where the weaker dollar has come into play. And also why a sector like tech is really pulling up the revisions ratio, the positive revisions ratio. The weaker dollar has been a big part of that.
Lizanne, when it comes to strategies, we're all aware of the Trump put. That was really prevalent as well in Trump's first administration. But you're pondering something new, the Trump call. What is that?
Well, the notion, of course, of the Trump put was, and we saw it come into play on April 9th, that if there's enough weakness that kicks into the market, in the case of that first week in April, it wasn't just in the equity market. You saw the spike in bond yields. You saw the crush in the dollar. That combination sent a message to the administration, whoa, hence the announcement of the 90-ish delay for the reciprocal tariffs. But I think the open question that maybe we're getting a little bit of an answer to is if you get enough resilience in economic data, labor market data, you don't start to see a move higher with any, meaningful magnitude in the inflation data and the stock market trading at all-time highs, does that beholden the administration to sort of press forward with tariffs? So just the opposite way to think about it from an options lingo perspective.
Raises big questions about August 1. Lizanne, as always, perfect framing of things. Lizanne Sonders there.
Thank you.
At Charles Schwab on the latest in the equity market. Just to pick up on what Lizanne said about the K-shaped economy, you can apply that to AI. You've got baseball-style contracts for some people at Meta. It's going to be harder to get a job for many others. Get into these companies.
Yeah, there's a consolidation of work in a smaller group of people, which raises a question about structurally what AI does to the economy, which I'm sure that you're concerned about, given the fact that one person can do a lot more with their time and their space. And if they are, a brilliant member of society, then maybe they'll be given that. I do want to say, can you buy brilliance? Can you buy a culture of creation, or is this going to be really emblematic of Meta's struggles with really being at the vanguard of the AI trends?
Mark Zuckerberg clearly thinks you can, and we'll see how it works out. Futures this morning, fairly stable on the S&P 500, very close to all-time highs. Tremendous numbers coming out of Delta Airlines and really putting the pressure on the rest of corporate America through the rest of this earnings season. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. OPEC has barred 5 news organisations, including Bloomberg News, from covering its biennial oil seminar in Vienna. The New York Times, Reuters, the FT and the Wall Street Journal are also excluded. OPEC offered no explanation for its decision, but the bloc's de facto leader, Saudi Arabia, has publicly criticised journalists for their reporting on the cartel. Elsewhere, Nvidia founder Jensen Huang will meet with Chinese officials in Beijing next week, doubling down on the company's commitment to the world's largest semiconductor market despite US curbs. Sources telling us here at Bloomberg that Huang's planning to meet with leaders while in the country to attend an expo. And Elon Musk said that his AI chatbot Grok is coming to Tesla next week at the latest. This after Musk's AI startup XAI rolled out Grok 4 after it was forced to remove the bot's anti-Semitic comments and replies to X users. Musk touting the bot as, quote, smarter than almost all graduate students in all disciplines simultaneously. And that's Bloomberg Brief. John.
Lizzie, thank you. More from Lizzie in about 30 minutes' time. Up next on the programme, the president goes big.
Sir, can you explain how you calculated your latest round of tariffs? Was there a formula that was used?
The formula was a formula based on common sense, based on deficits, based on how we've been treated over the years, and based on raw numbers.
Up next, Michael Zezas of Morgan Stanley. Live from New York City this morning. Good morning. Season begins. The stock is higher in the pre-market. Delta Airlines up by close to 12% now. And its session highs, better results, reinstating guidance, and a real sign of confidence from the CEO at Bastion. That stock is higher by close to 12%. The broader equity market, equity futures shaping up as follows, just about unchanged on the S&P 500. The Nasdaq 100 briefly turning positive after a 30% plus rally off the April low. For mega cap tech, just absolutely phenomenal. Under surveillance this morning, looking to trade, the president goes big.
Sir, can you explain how you calculated your latest round of tariffs? Was there a formula that was used?
The formula was a formula based on common sense, based on deficits, based on how we've been treated over the years, and based on raw numbers. Brazil, as an example, has been not good to us, not good at all. But they're based on very substantial facts and also past history.
Here's the latest this morning. President Trump confirming that the US will begin levying a 50% tariff on copper imports starting August 1st after the White House sent a new round of tariff letters to trade partners. Bloomberg's Tyler Kendall joins us now for more. Good morning, Tyler.
Yeah, hey, John, good morning. Well, August 1st is now apparently serving multiple deadlines for the administration as President Trump confirms that is when that 50% tariff is going to go into place. There are still a lot of big questions here, including which products are going to be covered, since we know that sector-specific tariffs are often extended to those downstream products. But we didn't get much information from President Trump beyond what he posted on Truth Social. He did say that he received a robust, in his words, national security review, which would indicate to us that Section 232 investigation on the grounds of national security concerns is likely completed, but that public report has yet to be released. Going forward here, we know that the sector-specific tariffs are coming into the negotiations for the so-called reciprocal tariffs, as now 22 nations have received letters with these updated tariff rates. By and large, a lot of the differences outlined compared to the rates that they received on April 2nd are pretty marginal when you look at which countries received them, such as Japan or South Korea, or yesterday with the Philippines and Indonesia. Except, of course, the one big exception here is Brazil, which is seeing its tariff hiked up from that 10% baseline rate to 50%, while Brazil has run its own trade deficit. The U.S. has a surplus with Brazil. It is clear that President Trump is using a different sort of basis here to impose it. John, he is linking this to an ongoing trial of the former Brazilian President Bolsonaro. We're waiting to see how this develops and what sort of legal basis the administration is going to invoke here if they do choose to move forward with this plan by that August 1st date.
Some big questions about that one. Tyler Kendall, thank you, down in Washington, D.C. Just where will we be on August 1st? Michael Zezas of Morgan Stanley writes, we'd expect countries like the EU and Japan to eventually stay at the current 10% baseline rate, albeit with potential announcements that these rates could go higher in the future. Michael joins us now for more. Michael, good morning.
Hey, good morning.
You said base case they would kick the can.
Yeah.
They've kicked the can. Will they do it again on August 1st?
So I think actually we got us a little bit between kind of kicking the can and what we call tactical escalation. And so I think between now and August 1st, it's really important in particular, I think, to pay attention to the China situation, because I think what we have with kind of the rest of the world, ex-China, Mexico, and Canada, which are, of course, the biggest U.S. trading partners, there's kind of a range now, right? Call it like negotiating space. And when you add it up, the kind of effective U.S. tariff rate based on that range is like 15 to 20%. And that's the kind of dynamic that it doesn't eliminate uncertainty. I heard you guys talking earlier about clarity, and did we get clarity? I'm like, we got a little bit more clarity. But it's something that sort of clearly underpins, we think, is slower growth for the U.S., but not necessarily a recession. But then the next leg of this is, are we doing any further escalation with China? Are we doing any further escalation with Mexico and Canada? And so I don't know that we'll learn that on August 1st, right? We might learn a little bit more precision within that 15 to 20% range. But if the U.S. elects to sort of re-escalate with China to negotiate, perhaps they feel like the embargo level on tariffs instead of 30% is 60%, and they want to act within that 30 to 60% range. That's the type of dynamic that might upset right now what we think is a market that's pretty good for bonds, not necessarily good for the dollar, but fine for equities.
Given the environment the administration is in with the world, are they going to have allies lining up with them when it comes to negotiating with China?
I mean, it's really unclear, right? I mean, a lot of the aspects of the individual bilateral negotiations are sort of asking to harmonize how these trade partners are acting vis-a-vis China. And that does seem to have been a bit of a sticking point. The Vietnam model is sort of an interesting one where it doesn't look like Vietnam agreed to kind of harmonize all these tariff barriers, but the U.S. said, okay, fine, if there are going to be products that come via Vietnam and we can't sort of validate that they didn't come from China, we'll give you a higher level. This seems to be a bit of a sticking point with Japan as well. The real game on this, I think, is going to be Mexico and Canada. If those barriers can't be harmonized, then it's really hard to kind of see that was effectively USMCA zero or near zero levels could be preserved. We're optimistic that they can do that, but I think that's a really important point to pay attention to.
How do you take these letters credible when the president goes after Brazil for a domestic political issue?
I mean, they're credible in the sense I think they represent what the president's true fallback position is, right?
Right, but the executive order was IEPA because of a national security concern, because of trade deficits.
Right.
That's not apparent with Brazil vis-a-vis trade with America.
Right. Well, I think the practical aspect here is that even if IEPA isn't the tool, right, so even in a court challenge situation, if IEPA isn't held up as the tool that can justify these, there are fallback options that the president can fall back to. 301 studies, temporary 144 authorities. So it's not that I think that we shouldn't be debating whether or not these are appropriate authorities, but that the idea that courts can maybe step in and say, no, this wasn't the right use, and so therefore the tariffs go away, it's probably not the right way to think about it if you're trying to trade this.
You said that we have gotten some certainty, and we certainly have when it comes to the legislative front. We got the One Big Beautiful Bill passed in Washington, D.C., and it's very tied to the trade issue. This idea of revenues coming from these tariffs are really offsetting some of the extra expenditures. Putting aside whether you're free trade or not, how much does that really create a bill that isn't quite as deficit producing as some people are estimating?
Yeah, I mean, it's pretty substantial. So if instead of just looking at the bill, you say, okay, let's look at the total policy actions of the administration, what it means for the deficit year over year, and you just kind of focus and isolate on that, the incoming tariff revenues are probably mitigating that year over year deficit impact down from something like 200 billion to south of 100 billion, right? So it's a pretty meaningful for 2026. There are other things escalating the deficit next year, but that's pretty meaningful. Of course, we're collecting tariff revenues. That's kind of a tax on the economy. So now there's this kind of dichotomy between, okay, what economists say is that this is lowering growth pretty meaningfully relative to potential. And so you'd expect the bond market to kind of reflect that and yields to go lower, and that's our call. But how is the equity market doing so well? It's like, well, large cap stocks aren't necessarily as exposed to some of these kind of broad tariff levels. They are somewhat exposed to some of the tax roll forwards in the One Big Beautiful Bill that give them some positive uplift in earnings. And so there's this kind of tricky balance here in the total policy set that seems to be good for bonds and good for equities. But where things, for example, might shrink the deficit lower, if you were to ratchet up tariff levels higher on China, Mexico, and Canada, you would sort of, that balance would be very much upset by that.
Something that you've flagged is you're worried about local governments and how much state and governments are going to have to lay people off in a way that we haven't fully appreciated, that's really going to affect the overall economy in a significant way. Have you revamped that estimate based on what we got on the legislative front?
I mean, we're still sharpening our pencils on all of that. But I mean, what I'd say here is that there's a lot of hard data that we should see over the back half of the year, in particular, and sort of in the fall and into next year, that should reflect these policy choices that we're just kind of not seeing yet, right? So our economists have written about the lagged effects of tariff implementation, usually around like a 4-month effect, right? So what we haven't seen yet is companies have to kind of make this choice between, can I test passing on this cost and price, or do I have to eat the cost and sort of deal with cost management, i.e. layoffs, to deal with this yet. So I think the fall is going to be really instructive as to what the actual impact is. And by the way, right now, this kind of idea of negotiating space, the administration can kind of act and negotiate without having to really kind of experience the economic and political feedback of everything that they're doing right now.
Doing a quick Fed survey in the seconds we've got, so you can just pick a name or pass, okay? Kevin, Chris Scott, wildcard.
Pass.
Okay, I thought so. Michael Zezas of Morgan Stanley. Michael, thank you, sir. Up next on the programme, the former US Vice President Mike Pence on tariffs, foreign policy and much more. Plus, Yahara Anand with your morning movers. Check out Delta this morning, surging after it reinstated its full-year guidance. That stock is higher by 12%.
Wait, one more time. Can you do that one more time?
Kevin, Chris Scott, wildcard.
Ask the Vice President.
Kevin, Chris Scott, wildcard. Kevin, Chris Scott.
You got it? We'll play that next,
Thank
all
you.
right?
Okay.
From New York City, you're watching Bloomberg TV. Live from New York City this morning. Good morning to you all. Equity futures on the S&P 500 shaping up as follows. Almost totally unchanged now. Erasing this morning's losses off the back of much better numbers from Delta Airlines. We'll get to those numbers in just a moment. On the Nasdaq 100, just about unchanged as well. With 2 hours until the cash open, let's get you those morning movers with Yahira. Hey, Yahira.
Hi, John. We start with our big mover of the morning, and that is Delta Airlines. Shares are flying up 12% after the company reinstated its 2025 profit outlook just 3 months after it pulled it amid all that tariff chaos. But it is a new day, and CEO Ed Bastian says there is now clarity and the environment is incredibly stable. And because of that, they expect adjusted profit of $5.25 to $6.25 a share this year. That is below the January's pulled guidance, but it did top Wall Street estimates. What a way to kick off earnings season. Next up, we have the American mining giant Freeport-McMoRan up nearly 3% now after Trump made it official, saying that 50% tariffs on copper imports will take effect on August 1st. And because of that, the American copper producer is getting an upgrade over at JPMorgan, which also set a new price target of $56. That implies more than a 20% upside from here and would mark the stock's highest close in over a decade. And we end with Circle shares. They are up 3% on our reporting that the Jack Ma-backed Ant Group is working to bring Circle's USDC stablecoin onto its blockchain platform. John?
Yahira, thank you. More from Yahira in about 60 minutes' time. On our radar this morning, one of our top stories, President Donald Trump confirming 50% tariffs on copper imports will begin August 1st. Trump posting on social media, America will once again build a dominant copper industry.
So unlike what's going on with Brazil when it comes to copper, the president is saying this is necessary because of national security concerns, the use of copper in the military industrial complex. I think a lot of people are viewing this as we were expecting this the same way the president went after aluminum and steel because of national security concerns. The questions that are lingering are his use of tariffs for things like domestic politics in another country. And people are concerned whether or not this is going to continue. This is a lever the president is going to use. And when people like Delta are saying there's some clarity and now the direction of travel is clear, and then you see something like Brazil, it makes you think, is the direction of travel really clear?
This mining entrepreneur, Robert Friedland, in the Financial Times came out and said, this is good. And short term, the market's not going to like it, but long term, the United States needs to produce its own raw materials, especially if you have an increasingly fraught and geopolitically fractured world. He was talking about how they're going to expedite some of those contracts in Arizona as well, particularly for mines that he has. And that, I think, is where the focus is going to really shift. How quickly can you get that production up to speed?
Music to the ears of Rio Tinto and BHP Billiton, I'm sure. Annmarie mentioned the likes of Delta. Amazon and Delta are telling two very different stories about the consumer right now. A disappointing start for Amazon's 4-day Prime Sales event. According to Momentum Commerce, sales plunged 41% on the first day compared to a year ago. Many analysts still saying the event can be a success over the last year's 2 days of sales.
It's a longer time period, so people might buy less in each of the days, first of all. Second of all, the deals aren't that good. And third of all, people buy from Amazon all year long, and everyone's having a day. I mean, it's Walmart day, it's Costco day, it's Bramo day. I mean, at a certain point, I think people are just like, all right, if I need soap, I'll get soap.
Meta employees having a day as well. These contracts are amazing. Apple's AI models team, his head, poached and getting a pay package worth $200 million. Sources telling us here at Bloomberg the deal will be stretched over several years. The compensation coming in line with similar hires for Meta's super intelligence team, and that team keeps getting bigger.
Yeah, we've been talking about how instead of acquiring another company, they've just out and out hired some of the top talent from said companies. A couple key questions here. What exactly is Mark Zuckerberg trying to build? Right? Exactly what is he trying to create for such a high cost, number one? Number two, why is he so desperate to do it? What existential threat is he seeing that they're not conquering right now? And number three, can they just hire brilliance? Or do you have to create a culture of creation that actually leads to the innovation that he's looking for?
Can I ask him the first question?
Sure.
Maybe he doesn't know. He just wants to make sure they can't build it.
The problem with that is if you just get people in a room and they're at odds at one another. This has been one of the accusations of Meta, actually, if you look at some of the allegations from people who have left the company, that they're people who are all working against each other, and it's created this feeling of kind of hoarding and secrecy and kind of a culture that isn't conducive to real kind of collaboration and pushing forward.
Sounds like Washington. Yeah. Let's do that.
That's brilliant.
Let's turn to Washington and turn to trade. The former U.S. Vice President Mike Pence taking a critical stance on President Trump's tariffs, writing in a Wall Street Journal op-ed in the past few months that since the president announced his Liberation Day tariffs, the only thing America has been liberated from is trillions of dollars in investments. I'm pleased to say the 48th Vice President of the United States, Mike Pence, joins us now for more. Mr. Vice President, good morning.
Good morning. Thanks for having me on.
Thank you for being here. I want to pick up on a question I know you've been exploring. What can 47 learn from 45? Let's start there and talk about trade.
Well, first off, I want to give President Trump all the credit in the world for a historic political comeback. But in that Republican primary, I was traveling as a candidate in 2023. I mostly heard people saying, we want to get back in the midst of the failed economic policies of the Biden administration. We want to get back to what the Trump-Pence administration was advancing. And so in the Wall Street Journal, I gave the president great credit, high marks for securing the border, for restoring morale and recruitment in our military, for taking the fight to the Houthis. Since then, we'll talk more later, I'm very encouraged about the strong stand that the president is taking on the world stage, particularly in the Middle East and in Eastern Europe. But what I wanted to call attention to was the policy toward tariffs was changed with Liberation Day. During our administration, we used tariffs and the threat of tariffs, principally focused on China, to leverage changes in behavior. But the objective was to essentially lower trade barriers and expand trade. And in this administration, I think what we saw several months ago, now it's paused again happily, is the kind of broad-based industrial policy that I think ultimately will harm the American economy, will harm American consumers. And so we've spoken out against it. We've tried to take a stand. What I like to say is free trade with free nations, be tough on China, be tough on trade abusers, but have the objective of ultimately lowering trade barriers. And that's how America wins and prospers. That's how we won during our first term.
You've identified that change. What's your understanding of what's behind it? What's led that change?
Well, I think that what's changed is that I think the president feels, at least I perceive it. You know, sometimes I tell people I know President Trump better than his most ardent defenders. We served together for 4.5 years. We had a close working relationship. And I've said many times that President Trump is not an isolationist. He is someone deeply committed to free market capitalism. But for all of his career, he has been very sympathetic to protectionist thinking and philosophy. You can go back 30 years on YouTube and find Donald Trump saying the same things that President Trump is saying today. Now, he and I had many vigorous conversations during our 4 years about trade. I come from one of the leading exporting states in the country. What we make, we grow in Indiana, we sell to the world. But at the end of the day, I think what you're seeing is not different influences around President Trump. I think you're simply seeing him extending out into a philosophy of government and economics that he has long believed.
Were these impulses then there when during the first administration, and individuals like you maybe talked him out of it?
Well, I don't know that it was. I mean, there were a few times that I saw him change his mind on things, but I think it was more about priorities in the first term to make sure that we passed the tax cuts, rolled back regulation, unleashed American energy. And we changed the national consensus on China, China with its years of trade abuses. And I played a leading role in articulating that in the early going. And I'm incredibly proud of that record and glad that at least the Biden administration didn't change the tariff policy toward China. But for me, it was more about It was more about driving toward free trade agreements. I had the privilege of announcing the beginning of a free trade agreement with UK in the city of London. We renegotiated a free trade agreement with South Korea that's back in the news this week with new tariff threats. And I was leading with my counterpart in Japan. I was actually tasked with leading a working group for a free trade agreement with Japan. So for us, it was we saw an expansion of trade and opening markets as a key part of American growth. And right now, I actually believe that President Trump is driving toward a long-term change in industrial policy in America, where he sees permanent unilateral trade tariff barriers as beneficial to America in the long term. And as a free market conservative, it's something I just don't embrace.
Can you do that and isolate China with the rest of the world on board at the same time?
Well, Annmarie, I think that's the right question Senator Phil Gramm we had on Capitol Hill with our foundation yesterday, had over 100 staffers that came out to hear him. He had probably the best description of it. He said by going after all of the free nations that you're trading with, at the same time that you're trying to bring China farther along into opening markets and ending years of trade abuses. He said it's like dismissing your front line in a football game and expecting that you're going to take on the other side. Look, we need Japan, we need South Korea, we need Australia, we need the EU to continue to bring the kind of economic pressure on China that I believe is all that President Xi and the Chinese Communist Party will respect. We saw some change. Remember that phase one trade deal in the early days of 2020? Most people have long since forgotten it. There were bigger stories that year by far. But we saw when we imposed those $250 billion in tariffs, the Chinese came to the table quickly and began negotiations. And I still believe that's the right approach, with free trade with free nations being the backstop.
Mr. Vice President, I want to pick out a line in that Wall Street Journal op-ed that John was mentioning that you wrote. Mr. Trump's proposed tariffs would be the largest peacetime hike in American history, harming consumers and driving inflation.
Right.
President Trump, his administration has been talking about they're not going to be inflationary, that the producers in other countries are going to absorb it. Right. Are you seeing evidence that that's not the case? Are you really concerned about what this does to the economy?
Well, I really am. And I understand that that's the debate right now. We haven't seen the inflation from Liberation Day. And I think there's several reasons to explain that. Number one is the tariff regime was paused and has now been paused again. And the markets are responding to that, and businesses are responding. Secondly, I got to tell you, the businesses I talk to as I travel around the country have been spending an awful lot of money on inventory right now. You know, there's an old saying that where I come from that, I was born in the morning, but not yesterday morning. So people say these tariffs are coming. So why don't we fill the warehouse right now? And I think that's wise. But at the end of the day, I also think that the president on Liberation Day talked about 25%, 50%, 70% tariffs on countries. And seeing some of these early frameworks that end up, like with the UK with 10%, there's a temptation to say, well, that's just 10%. And so I think that's the reason why that's why businesses have not adjusted prices yet. But if we have a unilateral tariff of 10% on the American economy of all imported goods, that's 4 times the average tariff today. And the reality is that I watch, I spent a lot of time in that cabinet room. I watched a little bit of the cabinet meeting this week, and I saw Secretary Bessent speaking very glowingly about the projection is $300 billion in tariff revenue this year. Well, tariffs are a tax, and American importers and businesses and ultimately consumers pay almost all of that. And so literally a week after we managed to extend the Trump-Pence tax cuts and prevent a $2,000 tax increase on working families, the administration is right now boasting of the fact that that the average American household is going to see about $3,000 increase in the cost of goods, because we're paying that. So that's why I referred to Liberation Day. I said could well be the largest peacetime tax hike in American history. We've been pushing back on that. I welcome the pauses, but I really do believe the antidote here is free trade with free nations. Tough on China, but continue to drive toward lowering trade barriers and non-tariff subsidies.
You referred to the inflation risk. The White House would also like this Federal Reserve to cut interest rates. You've been in the room a few times, I'm sure, talking about this Federal Reserve. How did the president end up with a Fed chair that he dislikes so much? How did that happen?
I've been watching a lot of what the president's had to say about Jay Powell lately, and he did appoint him, so it's part of the awkward aspect here. Well, first, I think the President of the United States is fully entitled to express his opinion about both the Fed chair and about the Federal Reserve itself. I have long had great concerns about the dual mandate in the Federal Reserve. I think it confuses the issue. I mean, the Federal Reserve has this, for your viewers, has a dual mandate to protect the integrity of the dollar and achieve full employment. I think the Federal Reserve ought to just focus on the dollar. And I think that the hesitation that I have seen from the Fed chair and ostensibly the committee is that the uncertainty around these broad-based tariffs and the potential for inflation has slowed their intention and their earlier efforts at lowering rates. And so how the president got to where he considers the Federal Reserve chairman to be worthy of the nickname "too late," I can't really testify. But to me, pushing back on the idea that what seems to be holding up the Federal Reserve, although I read this morning that there's now more vigorous debate. I'm sure you've covered here on Bloomberg. On the committee. We may have a lowering of interest rates, which we certainly would welcome.
As you know, the president, one of his greatest strengths is to break the status quo and have very little respect for it. Are there limits to that? And is Fed independence an example of it?
Well, that's right. And I think, look, the president appoints the chairman of the Federal Reserve, and a careful study of American history shows I don't really accept that the Federal Reserve should be a completely separate agency, like a college of cardinals that we never refer to other than in respectful hush tones, John. I think the president ought to be able to express himself. Elected officials ought to be able to express themselves, because it's almost like that old saying about the Supreme Court, that justices do read the newspaper. And I expect that's also true of members of the Federal Reserve.
You have taken a balanced view on the current administration. You've been somewhat critical of trade. We've discussed that. Mm-hmm. I would say a ringing endorsement about their approach to the Middle East. So let's talk about that.
Yeah.
Where you were in your first term with the president, where he is in his second term, and what went wrong in between, from your standpoint, on the Middle East?
Well, I just think when Joe Biden returned to a policy of appeasement toward Iran, it really emboldened the enemies of Israel across the region. I traveled to Israel about 6 months after October 7th and saw what occurred there. And I would tell you, it's one of the things I'm probably most proud of in our administration. Not only did we change the national consensus on China, but we were probably the most pro-Israel administration since the reestablishment of the State of Israel in 1948. There's just simply no moving the American embassy to Jerusalem, recognizing the Golan Heights. These were all historic achievements that everyone told us would foment violence and discord across the Middle East. But again, another 2020 story that is long forgotten by many people is the Abraham Accords. I mean, we actually demonstrated that when you stand without in an unwavering way with Israel, that I call our most cherished ally throughout our history, it sends a very clear signal that makes peace more possible, not less possible. We also isolated Iran as never before. We unleashed our military to take down the ISIS caliphate. And of course, the president made the decision to take down Qasem Soleimani, the head of the Iran Revolutionary Guard. All of that had Iran on its back heels. The Biden administration changed that, went back to the Obama approach of re-engaging with the mullahs in Tehran. I think they were emboldened. The violence that we saw, whether it be October 7th with Hamas, one of their patron groups, or the Houthis, all were a result. I've always believed that weakness arouses evil, but peace comes through strength. And the weakness of the Biden administration, I think, created the conditions for the mayhem that the new Trump administration inherited. And that's why I've been so encouraged to see the strong stand the president has taken with Israel. We publicly encourage the use of American military assets. If Iran was not willing to dismantle their nuclear program, I believe it needed to be destroyed. And I commend the president for his decisive leadership and our incredible airmen who delivered those payloads.
You welcome those strikes on the Iranian nuclear facilities, but the president still talks about a deal with Iran. Do you think he'll do a deal at any cost?
Well, I hope not. I said in that Wall Street Journal piece that you cited, it was about 2 months ago, and one of my concerns, in addition to some of the tariff issues that we talked about, was that a lot of what we were hearing from the administration in the first 100 days sounded an awful lot like a new Iran nuclear deal. And we pushed back on that pretty hard. My hope is that the president, having seen both the run-up to the need for American action and also the response by the mullahs in Tehran, he'll keep his hand on the holster and look ultimately for achieving the objective that has been the stated U.S. policy through multiple administrations, that Iran can never be allowed to obtain a nuclear weapon or have a nuclear program of any kind.
When it comes to foreign policy, you've been very critical and hawkish on Russia. In the debate when you were running with President Trump in the first term, you called Putin a small and bullying dictator. Why do you think Trump has only just started changing his tune when it comes to Vladimir Putin?
Well, I've never had any illusions about Vladimir Putin.
No, but President Trump has.
Well, that remains to be seen. I would tell you that, I was on the Foreign Affairs Committee when I was in the Congress. Been a student of Vladimir Putin. He's never made a secret of his ambitions in Eastern Europe. It's something he's spoken about, written about. His aim has always been to reestablish the old Soviet sphere of influence in Eastern Europe. And I really do believe it was our administration in the Trump-Pence years that were the first to literally provide lethal aid to Ukraine. I think that's what discouraged Putin from crossing that border during those 4 years. I think it continues to be the only pathway toward peace today.
But forgive me, Mr. Vice President, to go back to Annmarie's question, what's changed? Because right now we've seen a president who's warned against Russia crossing certain red lines that Russia's crossed, and then the sanctions haven't come.
Right.
What do you think is going on?
Well, I'm hopeful that they will.
What makes you hopeful?
I am. I've seen some statements by my friend Senator Lindsey Graham, who just in the last few days said that the president told him to move the bill. And these new Russia sanctions, which are secondary sanctions against people that are doing business with Russia, that are subsidizing the war effort by oil purchases and energy purchases, I think can be enormously impactful. But I would say that I've made it very clear that my deep conviction is Vladimir Putin doesn't want peace. Vladimir Putin wants Ukraine. Despite the stops and starts that gave many of us concern, including that famous Oval Office meeting between the president and President Zelensky, who I came to know well, I sense that my old running mate is coming around to recognizing Putin's real intentions here. I mean, when I think that the clear irritation in the president's voice of having a conversation, and then to see some of the worst drone attacks launched in Kiev within a matter of hours is, I think, having its effect. But look, I just think that I was pleased that the president countermanded what had been a pause of aid to Ukraine last week, which I think was unfortunate wherever it originated. But I commend the president for reversing that decision. And my hope is when the Senate reconvenes that Senator Thune will put the Graham bill on the floor and put it on the president's desk. I think it's time. And it's my judgment. I've met Vladimir Putin. I've stood with him closer than I'm sitting next to you. I've told him things he didn't want to hear. And I think he is not a man who understands anything other than strength. This is a moment, I think, where it's in the interest of our country, it's in the interest of our allies in the region, and long-term peace in Eastern Europe for us to continue to provide military support to Ukraine, to put punishing sanctions on Russia until a just and lasting peace can be secured.
Mr. Vice President, appreciate your time, sir. Enjoyed the conversation.
Great.
It's good to see you. Thank you. The former Vice President of the United States there, Mike Pence. Up next on the program, we'll catch up with Matt Stucky of Northwestern Mutual, Liz Everett of the Bank of America Institute, Nela Richardson of ADP, plus Oksana Aronov of JPMorgan Asset Management.
My base case is that the president really likes tariffs. We are in for a much higher U.S. tariff regime.
There's a lot of uncertainty out there in terms of the effects of tariffs.
The only constant here is change. I don't necessarily think that August 1st is necessarily a hard and true date.
This is the end game. We'll certainly see more certainty. We've accepted the fact that tariffs are here to stay.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
What a morning already. Live from New York City this morning. Good morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now with equity futures doing okay. At the moment, equity futures just about positive on the S&P 500, supported by better than expected numbers and a decent outlook from Delta Airlines. On the Nasdaq, futures positive by about 0.1%. The next stop for this market, 30 minutes away, 8:30 Eastern Time. Jobless claims in America.
The focus really gets down to the real economy. You could look at the stock market and say everything's fine. Everything is fine with the big tech giants and Nvidia that's churning toward that $4 trillion dollar mark. Just numbers at this point. But the real question is, if you look under the hood, how much is this K-shaped economy really widening, where you do have an increasing number of people getting laid off? And what does that mean for a Fed that's increasingly political and increasingly torn from the inside?
More tariffs, more tariffs, more tariffs, but apparently clarity on the outlook. Isn't that amazing? Delta Airlines this morning cutting through the noise, saying we've got some clarity on the outlook, things have stabilized. Things have stabilized. They certainly don't feel stable, but at the moment for the C-suite, for corporate America, I think this sets the bar very high going into earnings season for everyone else trying to communicate and provide guidance.
This is the embodiment of so many economists who've come on this show and said peak uncertainty was April 2nd. Peak uncertainty was April 9th. We're past peak uncertainty. This can be positive. For Delta, they're saying our business is past peak uncertainty and we can come with some sort of forward guidance. You're correct. How much do other airlines in particular have to really give some sort of sense of clarity? And if they don't, how much are they going to be punished? Is this applicable to other industries as well? Can they have the same clarity if they're going to be subject to tariffs that are still in the process of being negotiated?
What's also so challenging when it comes to Delta is they're basically saying clarity where things are headed that allows them to start making plans. Okay, they have clarity of direction of travel, But what I still think is complicated is the details. The devil's in the details when it comes to the trade agreements, the frameworks, and the rates that are being set. I woke up this morning, with more questions with what's going on with copper, if there's going to be carve-outs, and exactly what products are going to be hit. And when it comes to Brazil, if Brazil is going to be used and it's not an issue of trade deficit, then does that mean this administration is going to go after more economies for other issues, like taking issue with what's going on with their domestic politics? So I woke up with a lot more questions, but I'm glad corporate America sees stability.
This market has moved on very quickly in the past few months as the bond market moved on as well. 10-year bond yields this morning higher by just a single basis point. The yield on that maturity is 4.34. Had a test yesterday, passed it. Auction, okay. Get another one later on this afternoon for 30-year debt.
Yeah, and in between, we got the Japanese 20-year auction, so that went okay. It didn't go terribly, it didn't go amazingly, but that's a good enough bar to cross. So if we get the same kind of reaction from the 30-year, do you get a break in the trend that we have seen, a 5-day trend of yields higher that was broken yesterday with this better-than-expected auction? Does that speak to anything big, or is this just sort of a technical kind of positioning issue? I keep going back to that. I mean, we're playing narrative roulette right now. Love playing it. I'll play it all day. It does feel, though, it's maybe too soon to make that extrapolation.
I want some of that Ed Bastian stability in my life, in this bond market, the 30-year yield. 487. Coming up on the programme, Matt Stucky of Northwestern Mutual on the importance of managing risk. We'll catch up with Liz Everett-Chrisberg, head of Bank of America's Institute, with a read on the US consumer, and Oksana Aronov of JPMorgan Asset Management on why the Fed is doing the right thing. We begin this hour with Stock Steady as President Donald Trump heightens trade tensions. Matt Stucky of Northwestern Mutual writing the following: we've been rebalancing away from areas of the market that are expensive or where risks are not well discounted. Matt joins us now for more. Matt, welcome to the programme, sir. Need an extra few lines on that quote. Which areas of that market? Just describe them.
Well, in terms of kind of what's expensive in markets, I think you look domestically here in the United States, and it's hard to ignore just the valuation higher that we've seen in U.S. large cap stocks. We're at cycle highs in terms of kind of where markets are trading today, making just a V-shaped recovery from where we were in April to where we sit today. You know, while on the positive side, earnings revisions are grinding higher on a forward 12-month basis against those rising expectations. We're paying 22.5 times forward earnings, and when we're talking about managing risks, one of the risks that we continue to monitor is kind of the direction and travel of the 10-year yield. I think in terms of kind of what could reset that multiple or what the price investors are paying for the S&P 500 is kind of the direction of the 10-year yield here. So in terms of managing risk, you know, that's the one front and center in front of us here.
So Matt, I've got to ask you about the bond market then, to explain what's going to happen with stocks going forward. Tell me what's going to happen with the bond market. 10-year auction yesterday, okay. Lisa mentioned what happened in Japan overnight. The 20-year auction seemed to go all right. Can we move on? And if not, why not?
You know, I think really from here, I think the direction of inflation is going to dictate kind of what happens with yields. You know, in terms of kind of what's going to dictate that, it's really kind of the direction of what the Federal Reserve is planning to do and how investors react to that. You know, there's an awful lot of easing already priced into the forward curve, you know, with cuts starting in September, another one probably by year end. If you start to see inflation data trend upwards in the third quarter as we kind of burn through those inventories that were built in Q1 and replace those inventories with higher rack rates on tariffs as those inventories get replenished and end up on consumer doorsteps, you know, that to me, I think is probably the question mark for kind of where the 10-year rate goes. Additionally, in terms of, you know, is the market at some point going to care about, you know, 6% plus deficits for the Federal Reserve? I think that's an open question.
There is a larger debate, and you're kind of making a controversial point. It used to be not so controversial, Matt, when people would say, well, if the 10-year gets above this level, then stocks are going to sell off. It's getting increasingly controversial because the stock market's being driven by big tech behemoths that aren't exactly interest rate sensitive. And you have a sort of damned if you do, damned if you don't on the Fed, where if the economic data is negative, they'll cut rates, but maybe not for the reason that you want. Why do you see this as being so crucial at a time when, honestly, there's a debate about the relevance of yields to stocks that seem to be beaten to their own drum?
Well, I think what we've seen throughout history, Lisa, is just, you know, once, at least in recent history, last couple of years, is once we kind of pass that 4.5% level on the 10-year yield, regardless of kind of whether a stock's in the technology sector or if it's outside of the Mag 7, that correlation to bond prices has increased across the spectrum. And so if that relationship holds true, if we do see rates grind higher in the back half of the year, and that's not necessarily our call, but it's just an exercise in risk management, we do expect that to reassert itself. And so regardless of probably, the ongoing financing and kind of balance sheet health of some of these large technology companies, I do think that correlation does matter, and cash flows are discounted at interest rates, and the higher the rates, the bigger the discounting function.
We're talking about all of these sort of what ifs. And people have kind of hit out in the certainties, which is the consistency of spending in the big tech names. NVIDIA flirting with $4 trillion in terms of a market cap valuation. Peter Bukvar came out with this, and I thought this was fascinating, to put perspective on $4 trillion, saying that that's about 3.6% of global GDP, and that at Cisco's peak back in March 2000, it accounted for about 1.6% of global GDP. Of course, this is going to raise questions. Are we looking at some kind of bubble-licious activity, given the fact that people are looking for a certainty and finding it in only the narrowest of stocks? How do you treat that type of question?
Well, I think there's two questions there, Lisa. One is kind of what happens in the short term and over the longer term. I think in the shorter term, you're looking at a company like NVIDIA or other companies in the technology sector. What do they all have in common? They have balance sheet strength. They have higher margins that can absorb tariff uncertainty. They have secular growth behind them in terms of the AI CapEx build out. And most importantly, they are leading this market higher in terms of earnings revisions. And if you're looking at kind of what's been working in markets the last couple of years, it's exactly that. It's quality stocks. It's companies with earnings revisions grinding higher. And from a valuation perspective, despite that $4 trillion of market cap, if you look at kind of where NVIDIA's been trading from a forward valuation perspective, they've continually met the moment in terms of exceeding expectations, and that valuation has never kind of really gotten out of control relative to some of the other areas of the market that are more speculative. And so it's just kind of been this perfect company in terms of meeting a secular wave of demand, while also exceeding kind of all analyst expectations as it relates to earnings.
Matt, you say in your notes that the markets are embracing the taco trade right now. How risky is that?
I think it does pose some risk. I mean, what I mean by markets embracing the taco trade is, right now effective tariff rates are in the area code of 10 to 12%. If indeed higher tariff rates are enacted on August 1st, we're talking about a stepping up of an effective tariff rate towards the high teens, potentially to the low 20s as more announcements are made. That's about a 2% or so hit to GDP. And if you're looking at how risks are priced today, just looking at the high yield bond market, spreads are only out 20 basis points from the year-to-date lows. They gapped out 200 basis points in April. And so, that's what I'm talking about in terms of markets embracing the taco trade. It's just investors really looking through potential weakness as a result of that. And I don't know if necessarily that's the most, the best risk management decision.
Matt, thoughtful, and it's good to see you. Matt Stucky there of Northwestern Mutual, and not the first time we've heard it so far this morning.
Yeah.
The president might back down, but back down with equities close to all-time highs and credit spreads near the tights of the year? That's a very different question.
Which really raises the issue of how much can you get into a market that has such high valuations, an increasing number of people are asking.
And also, the president right now, why would he back down if the market at this moment is not pushing back? He backed down when the bond markets were getting yippy and equities were falling off a cliff after April 2nd, Liberation Day. The market basically shrugged this off. So why would he back down now, especially as Kellyanne Shaw said yesterday, if you're at the end of a negotiation and you want to extract as much concessions as possible, he might get even more aggressive as we look towards August 1st.
And no sign of the yips yesterday at that 10-year auction.
Yeah, and how much of this is just because people are sick of being so pessimistic and some of the inflation expectations are coming down? And frankly, we are seeing some sharing of where the extra cost is going. It's not all going to the consumer, but, extrapolating that one out, go figure.
It's pretty interesting to see this fight play out in real time at the Federal Reserve.
It is.
You've got half the Federal Reserve right now saying one-off shock, we can look through it. The other half saying we don't know, let's wait, we'll see you again in September.
With them adding that you might actually be getting close to the neutral rate for the Federal Reserve. There's a real question. How much strength is there in the U.S. economy? And underpinning that has been the ongoing resilience in Delta, really pointing to it in a remarkably stable environment. What's stable? It's the U.S. economy, not necessarily policy, because that is anything but.
Max Kettner of HSBC last week, remember what he said when he published? He said, buy any sell-off this week on trade. Buy it because the bar is really low for corporate earnings going into next week. Well, I can tell you after Delta, that bar's inched up a bit, hasn't it? It's a little bit higher.
You got to give clarity. You got to give some sort of outlook. You need to give some explanation of what's going on. And I think it's going to be very interesting next week with the big U.S. banks, how much activity, mergers, acquisitions, deal planning, infrastructure spending is going to come back to the fore. Delta saying they have the conviction to go ahead with plans. Do you see that from the rest of corporate America?
Equity futures so far this morning, just about unchanged on the S&P 500. No drama here with an update on stories elsewhere this morning. With your Bloomberg brief, here's Lizzie Burden. Hey, Lizzie.
Hey, John. OPEC has barred 5 news organisations, including Bloomberg News, from covering its biennial oil seminar in Vienna. The New York Times, Reuters, the FT and the Wall Street Journal are also excluded. OPEC offered no explanation for its decision, but the bloc's de facto leader, Saudi Arabia, has publicly criticised journalists for their reporting on the cartel. And Delta Airlines surging in the pre-market. The company reported better than expected second quarter earnings and reinstated its full year guidance after pulling it last quarter. Delta's results were driven by international premium demand and loyalty travel. Demand for economy class trips in the US and abroad stalled. And Kellogg shares rallying after the Wall Street Journal reported the Italian candy maker Ferrero is nearing a $3 billion deal to buy the breakfast cereal conglomerate. The Fruit Loop maker has a market value of about $1.5 billion and more than $500 million in debt. The deal could be finalised as early as this week. And that should be my brief, John.
Lizzie, thank you. I might as well say that. I did want them to buy AC Milan and not Kellogg.
Instead of cereal. Okay. You don't like American cereal either. I mean, he has a lot of cash.
I'm
Maybe
not
he
a
could still
cereal
do it.
kind of guy. It's not just American cereal. I don't discriminate. Don't like any of it. Okay?
I think that you should put Nutella on Fruit Loops and make little stacks, and then you could have the perfect
That is
merger.
not Maha.
You're going to let the kids eat that? Yeah.
For dessert, maybe, with frosted
Right.
flakes on the side.
Wouldn't want to be around for the aftermath of that. Up next on the programme, the Morning Calls, plus Liz Everett Chrisberg, the head of the Bank of America Institute, on the state of the US consumer. That conversation just around the corner.
How is the equity market doing so well? It's like, well, large cap stocks aren't necessarily as exposed to some of these kind of broad tariff levels. They are somewhat exposed to some of the tax roll forwards in the One Big Beautiful Bill that give them some positive uplift in earnings. And so there's this kind of tricky balance here in the total policy set that seems to be good for bonds and good for equities.
Mike Zezas of Morgan Stanley. It's a better equity market, very close to all-time highs. Equity futures this morning just about unchanged on the S&P. Similar move on the Nasdaq 100. That's the price action. Here are your morning calls. First up, Goldman initiating coverage of Nvidia with a buy and 185 price target, saying the AI investment cycle can sustain growth. Your second call from HSBC upgrading AMD to buy and doubling its price target. The analyst saying there could be significant upside to 26 AI revenue. And finally, Citizens JMP raising its price target on Amazon, saying the company's ability to offer faster delivery can unlock additional retail growth. Their stock is down by about 1/3%. Let's turn back to the stock we're all watching this morning. Shares of Delta Airlines surging in the pre-market. With more, here's Yahara Anand. Hey, Yahara.
Hi, John. We were all waiting for this moment, not just because it's the kickoff to earnings season, but because Delta deeply disappointed back in April when it pulled guidance. But as you just said, it has reinstated its guidance. Now they expect adjusted profit of $5.25 to $6.25 a share this year. And while that's below January's pulled guidance, it still topped Wall Street estimates. And the good news did not stop there. It also beat in the second quarter overall, thanks to strong sales in premium international travel and also spending on its loyalty program. But they say that demand for trips in economy class have stalled. So not a good sign for the lower income consumer. Still, Delta's results are lifting all the airlines this morning, but we're taking a look at where we stand year to date. As you can see, it is not pretty. Delta, JetBlue, American, and United are all down double digits this year because domestic travel just hasn't picked up, especially in economy class, as Delta told us today. So they have been discounting in order to offset that lower capacity. But have we turned a corner? Are we in a better place? Well, Ed Bastian seems to think so. He called the current environment incredibly stable. And he gave us this quote here. He says, people are starting to understand with clarity where things are headed, and that allows them to start making plans whether to travel or invest in a business. So a vote of confidence on him there. John,
Yahara, appreciate it. Thanks for the update. We'll have more from Yahara later in the hour on some of the movers to watch into the opening bell. Let's stick with the US consumer. Bank of America releasing its monthly consumer checkpoint, highlighting ongoing softness into the summer months. The report finding spending rebounded in June, but didn't fully offset declines in both April and May. Joining us now to discuss is Liz Everett Chrisberg, the head of Bank of America Institute. Liz, good to see you.
Great to be here.
Let's just talk about where we are right now and also where we've been over the last few months, because this has been very confusing. We had this big pull forward, and now we feel like we've had some payback. Where are we now?
So I think it depends on if we're looking at services or if we're looking at retail. If we're looking at retail and we're looking at durables, things like electronics, things like furniture, we are still seeing spending kind of decline in those categories because you've got the payback from the tariff buy ahead. But for the first time in frankly a long time, we actually saw what drove the consumer spending up in June was retail spending. And it was in the, things like gas, some of that was pricing, but it was really broad-based, other than things like electronics and furniture. But grocery spending was up, general merchandise was up, clothing was up. That's what's driving the spending. Interestingly, also, services spending was actually down just a little bit, down about 0.1 in June. But breaking that down, people are pulling back on discretionary, on travel, and we can get into that because you're going to want me to square the circle with Delta.
Well, yes. Can we get there right away?
We'll get there right away.
We'll get there right away. Carry on.
So travel spending, travel categories like airlines did decline. But if you delve into what drives total spending, right, it's the number of households that are spending, it's the average transaction size, and it's the number of transactions they're making a month, right? What we saw when you break that down, there are certain households, and we can get into which ones, lower income households, who are pulling back completely from making purchases in travel. If we look at other categories, discretionary categories like restaurants, on the other hand, again, same analysis. You're seeing fewer, but some households pull back completely. So we have fewer households making a transaction at all. But the people who are still going out to eat are going out more often, went out more often in June, and paid more. So you've got a little bit of a disconnect, and it's kind of a tale of two cities.
We've been talking about the K-shaped economy, and it seems to be just sort of widening the gap between the haves and the have-nots. And we're seeing people who have the money to spend more, and the people who don't spend less and less. And I just wonder if this is analogous to what we've seen over the past few years, or if this is almost an acceleration of that trend, if it feels unsustainable. If you can give us a sense of historically what this trend is heading toward.
So there is a disconnect, and I think the best way to understand what's happening is to look at the labor market. The labor market on its whole has been very strong, but digging in again by income, higher income households last month, we look at the money actually coming into accounts. That accelerated, third month in a row, it's up just shy of 3%. Lower income households actually decelerated a little bit. They're still up 1.6%, but that's down from 1.8%. So you're seeing this difference. That being said, we go back a year, 2 years, what was happening, lower income households were having double digit income gains. That's come down, whereas higher income households is particularly, a year, 18 months ago when we saw a lot of tech layoffs, higher income households had negative wage growth. Now they're coming up, and then they're also supported by higher income households having more invested in the markets are also being supported by that. So I think that's kind of the explanation for why the consumer is behaving the way that it is. It comes down to the labor market.
When you say lower income households are pulling back,
yeah,
what's the reasoning you find behind it? Is it because their wages are not keeping up with inflation, or is it actually this concern about policy in Washington, tariffs and the likes?
So one of the things we do at Bank of America Institute is we don't actually ask people what they think, because we find that when they tell us what they're doing, it doesn't necessarily align with what they say. So we look at what they are actually doing. So I can't tell you why they're doing it, specifically why they think they're doing it. But what I can tell you is that looking at the breakdown in where people are spending, non-discretionary spending items, rents, insurance, utilities, those are growing faster than inflation. They're taking up a bigger piece of people's budget. And now that wages are growing, they're still growing, but growing more slowly, not keeping up. That's where I think the disconnect is.
The refocus on necessities. That's what it seems to be.
Which doesn't speak well to their ability to withstand any further increases, but also the idea that higher income households are seeing an acceleration in income. At the same time, you're seeing a deceleration in lower income. That is different than what we saw in the immediate post-pandemic reality.
The K-shaped economy has been a theme this morning, hasn't it?
Mm-hmm. It has. And I just wonder how sustainable that is. And it is a political issue as well.
Liz, it's good to see you. Thanks for dropping by. Clinic, just great to talk about the data and, not feelings and all of that stuff, just hard numbers.
I love what Liz just said there. We look at what people actually do because we find that it actually breaks down, and rather than asking why they're doing it or why they think they're doing it.
This is not the UMich survey.
Exactly.
This is not the UMich survey.
We're not.
I'm saying that for
exactly.
you.
Thank you.
Coming up on the programme, jobless claims just around the corner. We'll catch up with Nela Richardson of ADP here to react, to look through the labour market. The headline number in payroll is pretty solid just last week. The details, as Citi pointed out, fragile for some of you. We'll get into that in just a moment. Equity futures on the S&P 500 so far this morning, just about steady. On the S&P, we're negative by not even 0.1%. From New York, you're watching Bloomberg TV. Just got a note from Max Kettner of HSBC, and the title literally is just two words, and it says buy more. That guy is bullish right now, constructive on this equity market. Equity futures at the moment just about unchanged on the S&P. Unchanged through most of this morning off the back of better than expected numbers from Delta Airlines. Will the data this morning speak to that theme of confidence coming from the C-suite at one of the major airlines in America? With your jobless claim number, the survey was 235. With the number, here's Mike McKee. Good morning, Mike.
Good morning, John. We're waiting for the number to drop here. I might warn that we could see a bit of a decline because last week was the holiday week, the July 4th week, and we go down to 227 from a revised 232. I wouldn't take too much comfort in this, in the sense that, as I mentioned, we had the holiday week, the July 4th holiday, fewer people able to get to the offices and file. 4-week moving average, 235 down from 241, and continuing claims go up 1,965,000 from 1,955,000. So I think the way you would look at this is just to say this is more of the same. We're not seeing any real change in the labor market that you need to worry about at this point.
Mike McKee with the latest. Mike, I'll come back to you in just a moment. I want to bring in Nela Richardson of ADP. Nela, welcome to the programme, first of all, and then we can get into these numbers. Continuing claims, is it getting harder to get a job in America, and how much data supports that right now?
Yes. And you can see that. Continuing claims are running about 5% higher than they were last year. And it really begs a certain kind of question. If you look at labor force participation rates, we're a percentage point lower now than we were before the pandemic. And, we have this unemployment rate that stepped back from 4.2% in May to 4.1% in June. So if fewer people are either working or looking for work, why is it harder to get a job? And I think the answer is the same when you look at the markets. We have a very concentrated labor market, which is only hiring a very specific type of person.
I'm looking right now, and I'm glad that John brought up continuing claims, because continuing claims came in at the highest level, just grinding to the highest levels since November of 2021. And it raises a question of whether we're seeing breaking points, even if the all-in number will not break. In other words, are there things that people will be able to point to that really show true profound weakness but on an overall basis, it isn't going to be disinflationary. It isn't going to create the backdrop that the Fed might need in order to cut rates.
That's right. We're in a labor market that's, I've used the word here before, in stasis. It's not moving much. It's pretty solid, 4.1% unemployment rate. You would never argue with that number in any time period. And yet you see how concentrated. So most of the jobs that the BLS reported last month were in healthcare, about 80% of those jobs. You add education, that was about 90% of the private sector jobs that were reported. And so where are the cracks? Well, the cracks are in white-collar jobs. The cracks are in professional services, B2B businesses, financial services. There are places that are not hiring. And right now, we don't know if it's a demand or a supply issue, because there's also a sense that labor supply is not being filtered to where the areas that are needed most, like specialty trades, for example, in construction or nursing and healthcare. There are parts of the economy that desperately needs workers, and they're not being matched right now.
So here's the issue. A lot of people have been saying that because immigrants haven't been coming in, or because the wave of illegal immigration has been staved off, or there have been deportations, that there is going to be wage inflation in certain industries that are going to have a harder time filling those roles. Is there any evidence that that's the case?
Well, across the board, there's wage inflation. The complexion of the labor market, and I think this is a little understood point, has changed dramatically since the pandemic. It ushered in a completely different pay structure than the one that existed prior to March of 2020. The composition of the labor market has shifted. We have more young workers in the labor market than we did before. The percentage of workers 45 and older have actually decreased by 2% over the last 5 years. And the nexus of all this churn from the Great Resignation and that supercharged hiring after the pandemic is a wage growth that is higher and more persistently higher at stable levels than before the pandemic. So just to put a number to it, before the pandemic, this labor market was characterized by very slow pay growth. We clocked that pay growth at about 0.4%. in the first 4 months of the prior to the pandemic. Now we clock it at 2.5%. So this is a elevated pay growth level that is structuring the labor market, and that has all kinds of implications for the workforce.
But is it across all sectors? To Lisa's point, the Treasury Secretary continuously talks about when you close the border, American wages go up. Is that true in those sectors that historically have been filled by immigrants?
Well, that's the thing about economics. You can't look at one sector and call it done. You have to look at the fill-through rate through the entire economy. Does that lower demand? Does that lower consumption patterns? Does that change the composition of the workforce? Does that force firms to hire or raise or lower prices? So it's hard to really come out and say there is one clear answer to that. You kind of have to see how the equilibrium shakes out. But overall, what we're tracking is a higher for longer pay growth that's much higher than what was before the pandemic. And it feeds into the idea that the labor market, though not a source of inflation, can put a floor on that inflation and keep it from going as low as it was prior to the pandemic.
You've been talking about this low churn dynamic in this labour market continuously now for the last several months. And I have to say, Lisa, the data again this morning speaks to it, both on the hiring side and the firing side. Limited firings, initial jobless claims back down to 227. Limited hiring, continuing claims speak to the idea that it's difficult to get a job in America right now.
People aren't budging. People don't want to leave their jobs because they're worried about getting a new one, and companies don't want to fire their workers because they remember what happened during the pandemic. I'm glad, though, that you picked up on continuing claims, because it speaks to the inability to easily get a job in the same way that maybe people were able to a couple of years ago.
And Mike McKee, I want to come back to you briefly. Just frame this for us. The debate not just on inflation, but around the labour market on the FOMC after the minutes we got in the past 24 hours.
Well, the labor market is the Fed's primary indicator at the moment of what's going on with the economy, because they think that it will take a while for inflation to feed in, given the stretching out of the tariff impositions. But the labor market will give them an idea of whether or not companies are moving forward with cost containment efforts, because they're anticipating at this point that they are going to have higher input costs from tariffs. So it's worth keeping an eye on. But the other warning I have to give here in terms of jobless claims is we're getting into the season when auto companies shut down to retool their plants. In Michigan, we saw almost 9,000 jobless claims filed last week on an unadjusted basis. Those will go away in 2 weeks when the employees go back to work, but it's going to make it hard to get a clean reading again on what's going on the firing side while we go through this July period.
Mike McKee, thank you, sir, with the latest on the labour market. The labour market data right now is not screaming cut interest rates, which might disappoint the White House at the moment, which is piling the pressure on Fed Chair Jay Powell. Tyler Kendall joins us now for a little bit more. Tyler, never mind doubling down. I'm not sure tripling down quite covers it either. The president keeps pushing.
Yeah, John, he does keep pushing, and he's starting to pull on arguments from other members of his administration when it does come to this pressure against Jerome Powell. Yesterday, he elevated an accusation from his head of the Federal Housing Finance Agency, Bill Pulte, who is alleging without evidence that Jerome Powell misled Congress in testimony about recent renovations to the Fed's headquarters here in Washington. And President Trump said, if true, then Powell should resign. We should say that Jerome Powell has disputed media reports that the renovations were extravagant. But just add it to the list from this White House when it comes to its criticism of the Fed chair. They've also recently coalesced around this idea that the U.S. government is facing mounting debt service costs because of higher interest rates. And so these are sort of the latest in terms of the criticism here as the White House does look towards what the next future replacement could be. And our analysts at Bloomberg Economics say that there are 3 likely criteria that could make a candidate successful in being chosen. One is loyalty to the Trump administration. The second is credibility to the markets. But the third is something they called unconventionalism vis-a-vis the economic establishment. John, those are our analyst words, not mine, but essentially somebody who's not afraid to buck the trend here, as at the moment, the FOMC remains divided on the impact of tariffs and the outlook of the economy.
Tyler with the latest from Washington. Tyler, thank you. Nela Richardson, Kevin, Chris Scott, wild card. Going to choose a door?
No.
Didn't think so. What's the most convincing argument right now for lower rates of the Fed?
The labor market is holding steady. And so if they want to position for their projections, which is higher inflation, lower growth, then maybe this is the time to cut rates. But, I'm not in favor of that argument right now. I'd like to think that the economy actually grows stronger than expected in the second half. So if you have a pessimistic view of that growth rate and a pessimistic view of the inflation rate, you should be cutting rates now.
You've seen how divided they are on the Federal Reserve. Seems to be more broadly two groups at the moment. The group that says you can look through tariff-related inflation and a group that's not so sure. How would you convince one side versus the other right now of how you see things playing out?
First, I'd like to make the observation that dissension is a feature, not a bug of the FOMC.
We'd all agree. It's far better than groupthink, that's for sure.
Absolutely. When the direction of travel is known, the bandwagon is easy to get onto. But I think that driving that consensus is going to be a matter of, what do you think is the Fed's role? Is the Fed's role to keep pumping the economy towards a certain growth rate? Is that the secondary part of the mandate? I would argue not. It's really inflation and it's really the labor market. And when they are incompatible, that policy decision, go with inflation, fight it. And so we'll see how the Fed shakes out on this. I think there's just so many directions and so many views, but the role of the Fed chair, whoever it is to drive that consensus, drive that dissension into as much of a consensus as you can get to.
Just the counterfactual. If the Fed were to cut rates by 25, 50, 75 basis points, would that help equalize or even spur some activity in a static jobs market?
I think it would definitely spur activity in the markets. So
in the markets, the labor market.
75% roughly of the employers in America, employees of America work for firms with under 250 employees. These are small firms. They are dependent on loans, small business loans. So at the margin, yes, a basis cut of that magnitude would probably help them secure some capital at lower rates. It may translate into hiring that is solid. But what would do better than that for Main Street is keeping inflation under control. So it really is a trade-off. If you really think that inflation is going back down to the levels that we saw before the pandemic, cut away. But if there is some doubt in your mind, it's not good for Main Street to have the specter of inflation pushing their input prices higher.
And Nela, before you go, just a final question on the Federal Reserve. What you said about driving consensus, I think, is important. How difficult is it to do that when there's a changing of the guard, particularly in this environment?
I think it's going to be a challenge. I mean, it's a challenge already. It's just harder. The complexity of that decision has been amplified, mainly because the structure of the global economy is changing in real time. So it's really hard to drive a consensus when there's really no stability in the outcomes, and not just because of tariffs, because of demographics, because of AI and technology's impact on the workforce. There's all of these megatrends affecting the global economy, and you're the person in the room who's supposed to cut through all that noise into a 25 basis point cut or not. It's a hard job.
It's a complex time, that's for sure. Nela, it's good to see you. Appreciate your time. Thank you. Nela Richardson there of ADP. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Back with us, here's Lizzie Burden. Hey, Lizzie.
Hey, John. Starting with the latest data, weekly jobless claims coming in below expectations once again at 227,000 for the week that ended July 5th. The data marking the fourth straight week of declining claims to reach the lowest levels in 2 months. Continuing claims, though, rose to 1.97 million over the week, still at the highest since late 2021. And Meta poached the head of Apple's AI models team. Sources telling us here at Bloomberg that he was lured over with a pay package worth over $200 million that will be stretched over several years. The compensation is in line with other major hires for Meta's new superintelligence team, which is focused on building AI systems that can complete tasks as well as or better than humans. And Goldman Sachs is reportedly planning to ask its junior bankers to confirm their loyalty on a regular basis in a bid to limit talent poaching. Bloomberg sources say that the bank will ask new analysts to certify every 3 months that they haven't lined up jobs elsewhere. The move is meant to get ahead of private equity firms signing analysts early in their on-the-job training. And that's your Bloomberg Brief. John.
Lizzie, thank you. Provide the conditions where they don't want to leave. That's the job as the employer. We've been so harsh on this generation and how much they need and how much looking after they need. I have.
Yeah, I think so have I.
But on this occasion, give me a break. Pledge allegiance to the flag every time you turn up for work. What?
Tell me that you're insecure without saying out loud, I'm insecure. Just say, promise you're not going to take them up on their offers that are so good.
Compete.
Come on, please don't.
Give me a break. Up next on the programme, setting you up for the day ahead, plus Oksana Aronov of JPMorgan Asset Management on why the Fed is doing the right thing.
In this administration, I think what we saw several months ago, now it's paused again happily, is the kind of broad-based industrial policy that I think ultimately will harm the American economy, will harm American consumers. Be tough on China, be tough on trade abusers, but have the objective of ultimately lowering trade barriers, and that's how America wins and prospers.
That was the former US Vice President Mike Pence joining the programme earlier on this morning, critical of certain dimensions of the trade policy of this administration, but I have to say very constructive on many dimensions of foreign policy.
Definitely when it comes to foreign policy, especially he has been welcoming what the Trump administration did in terms of going after Iran's nuclear facilities. And this welcome reversal, really, we've seen out of the administration, according to Mike Pence, when it comes to how he is talking about Putin and the sanctions bill that's working its way through Congress. On trade, though, he is a free trader, but he's not a purist in the sense that he doesn't think you should rally the rest of the world and go after one place, and that's China.
If you are just tuning in, welcome to the programme. Equity futures doing okay so far this morning, negative by about 0.1%. Similar move on the Nasdaq, no drama here. Jobless claims are okay. Continuing claims still a bit of a concern. It's harder to get a job in the United States of America. As we count you down to the opening bell, some things to watch for in our trading diary. On Tuesday, looking ahead to next week, bank earnings kicking off with JPMorgan, Citi, Wells Fargo, plus CPI. On Wednesday, earnings from B of A, Goldman, Morgan Stanley, and we get some PPI data. Thursday, another round of jobless claims plus retail sales data, and Friday, UMich consumer sentiment. Before we get to all of that, a few more days to go. Plus this, looking ahead to a $22 billion sale of 30-year bonds after strong demand for the 10-year note triggered a rally. Oksana Aronov of JPMorgan writing, at some point, the realization that 5% is a fair value clearing level for the 10-year will finally start to creep in, causing all kinds of price disruptions. Oksana joins us now for more. Oksana, good morning.
Good morning.
That's going to worry a lot of people that quickly got comfortable with yesterday's auction. What is there to worry about? Why that move back to 5?
So we have to kind of zoom out a little bit and realize that in spite of all the talk around cutting rates and why it makes sense to cutting rates and this administration stomping its feet and demanding lower rates, right? The reality is that we've seen this movie before. The Fed did start to cut rates and did so very aggressively around this time last year, a little bit later, and we saw the long end move up. And the 30-year continues to be stuck around that 5% level. And currently, we have a stock market that's surging. We have crypto at all-time highs. We have a jobs backdrop that's still very constructive at 4.1%. There is really no impetus for the Fed to be any more aggressive here. But even more importantly, and this is where I disagree with the prior speaker and a lot of what's out there currently, it's irrelevant what they do at the front end because they do not control, so if we are talking about lower borrowing costs for small businesses or lower mortgage rates for borrowers who want to buy homes, that is not going to necessarily flow out of a lower Fed funds rate.
Which raises this issue of if they lower rates on the front end, how much will that actually generate growth and inflation that will cause the long end to go up to that 5-6% rate? I mean, exactly. That's ultimately the question. Why would it then affect the long end so much if it didn't have the stimulative effect in the short term?
So we saw kind of an interesting combination of factors when the Fed started hiking, right? Under any normal, quote unquote, circumstances, that would have been a restrictive environment, with the exception that we had tremendous fiscal loosening that essentially blunted the effect of monetary policy, I think. And we're continuing to see that. Financial conditions are quite constructive, quite loose. Once again, we have the big, beautiful bill contributing to an already, around a $2 trillion deficit, going to go up to about $2.5 trillion, right? So all of these things are inflationary. And from a technical standpoint, there is more and more issuance that the Treasury needs to finance. And that is not a constructive technical backdrop for the long end. So we're talking about, the macro backdrop, which is, tariffs and lower labor supply and immigration policy and kind of defense spending and all these sort of non-discretionary spending components of the budget that are going to continue to move up and contribute to the inflationary backdrop, which, by the way, inflation has completely stalled out. Right, any move down and it has completely stalled out. And in addition to all that macro stuff, we're also talking about the technicals, which are just going to continue to be not constructive for the long end to meaningfully move lower here, irrespective of, how many times this administration stomps its feet.
How do you put this all together in the sense that 10 out of the 19 officials, according to the minutes, think that we're going to get 2 cuts this year? And you think actually what the Fed is doing is correct right now?
Absolutely. Well, this is no different from any other year when we had, 7, 8, 6, 5, you name it, cuts baked in, and then ultimately ended up with a couple, albeit aggressive ones last year. I think this will be no different. We're going to continue to see even the Fed itself, right, when in the last kind of survey, when Fed members were surveyed in terms of where do they think risks are. Every one of them said that inflation risks are skewed to the upside. And many said that, the labor picture, the risks there are possibly skewed to the downside. And so far, the labor data has been okay. And by the way, I would argue that as population declines, we may not need the kind of blockbuster, jobs numbers we've seen in the past to continue to have a very constructive labor market.
You said that if yields go back up to that 5% level, and I'm talking about 10-year yields, it will pressure all sorts of other assets. Are you talking about credit at a time when a lot of people have been saying that it's a really constructive outlook, even at these tight spreads?
Particularly below investment grade credit, right? So investment grade credit has 2 things going for it. Number one, fundamentals there are, as constructive as they've been possibly ever. Yes, there's been some perhaps overspend on buybacks, but generally those balance sheets are good. And they also have the benefit of receiving support from the Fed as major employers of Americans, right? These are blue chip companies. And yes, the government and the Fed are going to come to their rescue if that needs to be the case. Below investment grade credit is in a different situation because these are not cash-rich flow companies. And I know that generally the pitch there is, well, defaults have been very low. The makeup of the high yield space is now higher quality. Well, let's really dissect that. So the 12-month trailing default yield for high yield is 1.3%, something like that. If you add to that distressed exchanges, that number nearly doubles to around 4.5% to 5%. If you add to that the PIK activity that we've seen, which is pay in kinds, which is essentially, I can't pay you back in cash, so here's more debt, right? Then we get to an even higher level. So in essence, if we were to really take stock of all the activity related to, I don't have the money to pay you back, we're ending up with a 5%-ish type default level, as opposed to the one handle that's being reported.
Oksana, appreciate your time.
Thank you.
It's good to see you. Thank you. Thank you very much. You're scaring us, though. Don't want 5%. Want nothing to do with that. Oksana Aronov of JPMorgan.
I want more.
Asset Management from New York. This is Bloomberg.